GETCRACK. Wake up, motherfucker.
Surprised at all that we're seeing Amazon shares move higher despite a very slight miss when it came to cloud?
Well, thanks for having me this morning, Frank. No, I think that you're right. It was a little bit below what people had hoped for, but it's the operating profit that blew away the numbers by 20% upside in the quarter. And they forecasted for operating profit to actually be above in the fourth quarter. So I think the combination of his bullish commentary, particularly on AI, and that very strong, profit margin is giving people a lot of hope.
Giving them a lot of hope, Jordan, but also 81% increase when it came to CapEx spending for AI. We've seen some other companies kind of get dinged for that. In your mind, was it the margin expansion? Was that what gave investors a lot of confidence that that spend is going the right way?
100%. I think if any of these companies were to show margin degradation or compression and continue to spend at these high rates, the stocks would definitely go down. Their multiples would contract. But the combination of very solid, healthy revenue growth at massive scale and the fact that they're seeing margin expansion, coupled with the comments by managements that they think this is a once in a kind of a lifetime opportunity to monetize AI in the future, I think is the reason why you're going to see more people buy versus sell on these prints.
All right, so Jordan, Andrew, coming over to you. I'm just looking at the growth here of these hyperscalers. Amazon, 19%, a bit below estimates, but still strong year-over-year growth. Microsoft, 33%, GCP at 35%. When we continue to see this growth when it comes to hyperscalers, what are the other companies out there that you see as potential beneficiaries of this incredible transition of workloads into the cloud?
Right. Thanks for having me, Frank, and good morning, Jordan, as well. So Datadog, I'd like to highlight, it's our top pick. They sell observability software, which helps monitor applications and infrastructure. If you think about your Starbucks app, your Peloton app, a lot of different apps you use every day are insured the reliability because of companies like Datadog. Those are Datadog customers. Datadog is a great partnership with AWS and the other hyperscalers, and they often get brought along quickly as those workloads move to the cloud because cloud infrastructure monitoring is their biggest product. And that's very important to ensure reliability of your cloud workloads. So they're viewed as probably the greatest cloud derivative play, if you will. There's several others that have similar usage-based models that have cloud stories as well. But Datadog's our top pick, and we can get into why.
That's your top pick, but it's kind of a duopoly when you're talking about that cloud monitoring. It's another company we've actually been fortunate enough to have here on the show, Dynatrace. How does that compare in your mind to Datadog, whether it's valuation, their ability to capture market share? I mean, how do you view them? Because it's a two-dog race, right? No pun intended with Datadog.
Yeah, exactly. Yeah, we like Dynatrace too. Just slightly lower growth, also lower valuation, but I view that as a great growth at a reasonable price stock that's about 30 times free cash flow. Datadog's about 40 times. But yeah, I mean, this market has consolidated from several vendors down to basically those two are the last pure play observability public stocks.
All right. Jordan, coming back over to you, kind of mixed results when it came to these Mag 7 earnings, specifically those names tied to AI, which is Meta, Microsoft, Amazon, Apple too, but also Alphabet. When we're looking at the reports from Microsoft and Meta, did you see signs of a kind of a weakness in this AI trade, or do you believe the narrative remains intact throughout the end of the year?
No, I didn't see any weakness. I mean, honestly, the only potential disappointment was one that Meta, the expectations were sky high. I mean, the stock's up, what, 70% this year, and they've been growing probably faster than most of their peers. And it just, the guide was better. It just maybe wasn't the blowout guide some people had hoped. I think that one comes back, and you see it get above 600 before not too long. Now, Microsoft, the one thing I'd say is you have to put in context the reason why maybe Azure growth wasn't as high as people hoped. They're basically saying it's down slightly in the coming quarter. And part of that is because they're capacity constrained. You know, they're still waiting for more data center and AI compute capacity. So this is all good for NVIDIA. It's all good for Micron. It's good for these silicon and hardware companies that are going to supply them the needed capacity because they have the business. They just don't have enough capacity. And they said it's probably 1 quarter to 2 quarters away from getting that.
You know, Jordan, until we get that NVIDIA report coming up on November the 20th, we're going to be talking about cloud infrastructure quite a bit, kind of the build up until we get to there. You're looking at another cloud infrastructure player, Supermicro, having some issues with its accounting firm. In your mind, the troubles at Supermicro, you say they create opportunity for different stocks. Just kind of explain that thesis for us.
Yeah, well, think about there's a handful of companies that take these GPUs, assemble them into massive multi-million-dollar rack systems that have power, cooling, and all the interconnect inside. And those companies are people like Supermicro, they're Dell, they're Hewlett Packard, they're Hanhai over in Asia. And so if Supermicro runs into trouble, which there clearly are, they could get delisted. They actually have negative working capital, meaning they need a lot of cash to buy the inventory and build the products. I don't know what's going to happen, but they need a new auditor and they need one fast. So what I'm saying is that if you're a customer and you're concerned or worried, or you're NVIDIA and you're worried about what could be happening at this Supermicro, maybe you give more of your GPU capacity and supply to a company like Dell. I mean, Dell's based in the US. They have a fantastic balance sheet. And I think that some of these customers are just not going to take the risk, and they could start moving these AI servers over to Dell. I think it's a great opportunity to look at the stock right here.
Jordan, one last question. We're talking about some of these issues for Supermicro. Supermicro is one of, I believe, the top 5 customers for NVIDIA. Does Supermicro's issues, does that translate to an issue for NVIDIA as well ahead of earnings?
I don't think at all. I think, you know, first of all, this accounting issue is something that probably gets resolved. So I don't think it's actually going to impact their day-to-day business. It's just really bad for the stock and investors. Secondly, I think that NVIDIA they didn't wake up this week and see the stock down and then start to not know that anything was going on. I think they're well ahead of this. They've talked to Supermicro, they know what's going on. And if anything, they will make sure that if there's any problem in fulfilling demand, they move those GPUs over to these other suppliers. And I don't see any real problem that they'll have at all. It's just optically, It doesn't look good.
Down a little bit this morning after fourth quarter results. The company actually beat expectations on both the bottom and the top lines, but they did have to make a one-time payment of 13 billion euros to Ireland to settle a dispute over back taxes. iPhone sales hit a record $46.2 billion, and the higher margin services business is now generating about $100 billion a year. Joining us right now is one of the analysts who was on the call, Wamsi Mohan from Bank of America Securities. Wamsi, the stock's down a little bit. Most of the numbers were pretty good, but that services number, even though it's continuing to generate a huge amount of cash and growing, was a little below what had been expected. Is that what you attribute the decline in the stock price, or is it something else?
Yeah, good morning, Becky. Thanks for having me. So as you said, I think most of the metrics in the quarter were more or less in line. In fact, iPhone was slightly better than expected. Services was a little bit weaker, and gross margins were strong. I think the reason the stock is indicated a little bit lower is really because of the guidance. And the guidance, consensus had it about 6 to 7% growth in the December quarter. What the company guided to was a low single to mid single digit increase on a year-on-year basis. So the top line was definitely a little bit weaker. Now, this was largely signaled and understood by the buy side, just given sellout data points were a little bit weaker. And there was a slightly slower start to Apple Intelligence rollout. We also think another factor here could be the fact that there is a CFO transition underway. And remember that Apple does want to set this up in a way where the incoming CEO does not want to be the first one going on the call reporting disappointing numbers. So I think the bar is also intentionally being set a little bit lower just to make sure that the CFO transition also is a smooth transition.
All right. Overall, though, the number for Apple iPhones, the iPhone 16, those were stronger sales than had been anticipated. And that's kind of the opposite of what the analyst community had been expecting up to this point.
Well, Becky, look, I mean, the September quarter is not a great tell, right? You've only got about a week of sales in the September quarter. So the iPhone upside was largely driven by the fact that the 15 cycle was still ending on a reasonably positive note, like 6% growth in iPhone sales, largely driven by, call it low single digit growth in units and low single digit growth in ASPs. The 16 cycle should be better. We do expect the 16 cycle to be up on a year-on-year basis. If you just do the math around the sequentials and what that implies for hardware, it does imply hardware flat to up. And generally, that really is not possible without iPhone growth. So iPhone is continuing to grow. It's the rate and pace that's a little bit under question. We would just remind people that this is a slightly different cycle from every cycle we've seen, right? There are continual software updates, which basically means that the cadence of the rollout is going to dictate which regions upgrade first, which regions upgrade later. And within that context, we also think that the mix shift to the Pro remains very, very strong, despite the fact that Apple Intelligence runs across the board. So we do think that it sets up for a reasonably good cycle, but we're really positive on the fact that this can be a multi-year cycle, given that as this rollout happens across different regions, you do get sort of this propensity to upgrade from a very large install base of iPhones to the newer phones that are capable of running Apple Intelligence.
And when it gets to the services business, a little weaker than it had been anticipated, is that a concern for you or no?
Yeah, look, we did take our services numbers down marginally. If we look at our full year estimate changes, our revenues went down about $5 billion, from $428 billion to $423 billion. So in the context of Apple, $5 billion is really not that massive a number. It's 4 cents on EPS on a, call it like 750 base, right? So again, like numbers didn't move a lot. And the reason for that is although revenues went down, the gross margins were very strong. The guided gross margins were extremely strong. For the first time in Apple's history, they've got a 47 number in their gross margin guidance at the high end of that range, which is just incredible. And this has been part of our thesis that gross margins are actually going from 45 to 50%. In the last decade, we've seen them expand from 35 to 45. We think in the next decade, we're seeing this expansion run up to 50. And frankly, it's actually outperforming even our expectations of how fast that's moving. So we really like the setup over here. We think the marginal number changes are insignificant. The thesis really remains unchanged.
Target for the stock?
Yeah, we have 256 for the stock.
Yo, what's up? What's up? Yo, what's up, OPC? Yeah, that was a good tip, huh, Antoine? I hope to give more. I mean, not all trades work out so well like that, you know. Sometimes they don't. But this is why when I give advice to people, I'm very cautious. I'm willing to take a hit for the short term if it doesn't work out a little bit. But this is why from now on, I'm gonna have to be very specific about what I mean. What prices where you should buy, and then adjust for the risk and say like, well, what's my what's what's my opinion. But when you enter a trade, you got to say like, hey, when the stock acts like something like this, I'm out. I'll eat a loss, right? Not every trade will work out. That's the problem. So it's a hard game, and most people won't like it. But I'm trying to make a process for you guys. So I think many of you guys, when you have a process in place, you're more likely to succeed, right? And every time I give something from now on, I'll try to give more indications where you should give up on a trade, say, hey, this ain't working, I'm leaving. And when I give a trade, like what's my anticipated probabilities that will work and the reason why and stuff like that. This is why for all of October, I've been giving a lot of advice in general terms, because you got to have a baseline knowledge. And then from there, we move up and we keep on increasing, we keep improving. We say like, all right, why didn't it work? What did I do wrong? This and that. You learn better from your mistakes, honestly. And this is where we want to go. Okay, Daniel Nixon, is bear banana stock. I think Dole, from Hawaii, right? Dole pineapples. I believe they also do bananas. So you can look at that. Is the stock ticker DOLE? Yes, it's still DOLE. Yeah, it's a really good stock. let me show the chart of Dole. There you are. You see that? Not bad, huh? So yes, I also look at avocado stocks. Interestingly enough, avocado stocks are quite profitable when you get them at the right times. Interestingly, so here you see Dole having a nice range between June of 2023 last year to June of 2024, right? And then it shoots up in July. So from 12 to 17. So yes, fruit stocks are quite profitable. It's right back to the top of the range here from 2021. Yeah, so let's see where it goes from here. But yes, banana stocks aren't bad. Pineapples aren't bad either. Now, I'm gonna look at some avocado stocks. Let me pull up this for you guys. Avocado stocks, yes. You think I'm joking? You think I'm joking? No, I'm not joking. Here's a list of avocado stocks. Mission Produce, AVO. Not bad, huh? If you bought it around here at 9.5, so $9.50, and got out at 13.5. Yeah, right here. Not bad. That would have been a good trade. I don't know if it's a good long-term thing because as you know, farming isn't really something that works well on the long term. So swing trading these things, yeah, you can. Chipotle, I don't know why. I guess Chipotle is tied to avocados in some way, right? Avocado prices, anyhow. So I guess that's why I put in the list. But here's another growing avocado farming stock. It's in a range since last year. So CVGW, Calavo Growers. So the first one was AVO Mission Produce. Second one, CVGW Calavo Growers. And we have this one, Limoneria, okay, LMNR company. So yes, there are some of these avocado stocks that you can look at. So that if that was a joke, Daniel Nixon, it wasn't really, because as you can see, you can make quite a bit of money trading companies that do produce like that. I think it will be hard for someone to really understand when the cycles are for those things. They're too dependent on growing season, growing patterns, how the company adjusts for that, things like that. But yeah, you can do it. There's almost a stock for anything you could think of. I remember there was the one, the Build-A-Bear stock, right? That's like you go to that factory and you can build your own stuffed teddy bear or something. Shit, man. That was a hot stock for a while too. Okay, milk cow, booger eater, snot drinker. I don't know if there are any stocks for boogers or snot, but all right, there you go. Okay, I think one of the things you heard from the first video about earnings the compression, right, of multiples. So that's why Amazon is one of those infamous companies. Chiquita, but yeah, Chiquita, I don't know. Chiquita. Let's see. Yeah, it is. CQB apparently is the ticker, but I don't know if it's I mean, it was the ticker. Maybe it's not there anymore. Yeah, I don't see it anymore. So maybe it used to be. It used to be, maybe. Yeah, it's not there. I don't see on TradingView. So maybe it used to trade, but it's no longer there. CQB, yeah, it used to be. Let's see, when was it? The blah blah blah. It's been delisted. I don't know why. Not sure why it was delisted, but yeah, it used to be. Last traded in 2014, probably. That was 10 years ago. Let's look at the company. What happened? Blah, blah, blah. Predecessor, United Brands. Headquarters, Switzerland and Fort Lauderdale, Florida. Maybe it got acquired or it got turned private. Let's see. Okay, it says acquisition. Yeah, it got acquired. Who acquired it? $611 million takeover by Cutarale of Brazil was rejected. Okay, someone tried to acquire it from Brazil. So okay, then they got accepted later on. Okay. Let's see if this has a stock. So Cutarale, if it has a stock, I don't know if it's listed in the U.S. markets though. Cutarale is one of the world's largest exporters of orange juice. Great. It's private. Yeah, sorry guys, you can't trade it. No more. Oh well. Yeah, that's kind of the problem. Sometimes, companies aren't going to be public. Yeah, that's it. So, PC Don, I know you want to buy Lolo's sewing business. I don't know. You're gonna have to fight Universal Jones for that, I think. Yeah, you're gonna have to make a hostile takeover. I don't know. Yeah, but okay. Let's look at the jobs report video right here. Let's look at the jobs report video. So you guys need to get a refresher. You guys need to get a little refresher on the labor market.
The October jobs report amidst 2 hurricanes and a significant labor strike indicates a challenging period for assessing the health of the U.S. labor market. Initial expectations suggested lower job growth, with forecasts ranging from a loss of 10,000 jobs to the addition of 110,000 new jobs, significantly influenced by these outside factors. The result was an unimpressive 12,000 jobs added, but the unemployment rate remained at 4.1%. The underlying reason for this is a robust labor market, as evidenced by the previous month's surprising 223,000 jobs added, revised down from the initially reported 254,000, and that steady unemployment rate. Despite these disruptions, the market remains cautiously optimistic, expecting a temporary dip rather than a systematic downturn, evidenced in part by the lowest level of respondents for this report since 1991. Markets believe job creation and consumer spending will remain resilient with the help of continued rate cuts by the Fed, despite the clouded immediate outlook for the jobs market.
Yeah, so the bond market on Friday did a funny thing. I'm not sure if it's just because of elections, but we dropped back down. So, but as far as the futures are concerned, the futures market says that the interest rates predictions haven't changed. So the probabilities anyhow. But if you look at the TLT here, yeah, we're below that blue area now. High volume day. So what I expect is next week into Powell, it should try to recover, hopefully. Now, if Powell says nasty things and the 30-year yield, so I can look at the 30-year yield. So remember, price of bonds is inverse the actual interest rate of the bonds. So when people do not buy a lot of bonds, the demand is very low. The interest rate of the bonds has to go up to attract new buyers. Okay, so you have to understand that it goes inverse. So if people are not willing to buy a bond, the Fed, when they do the auction, they have to raise the rates to attract new buyers, because the only way someone will buy a bond now is like, oh, you better give me a higher interest rate, and then I'll take a chance and make a 30-year commitment on your government bonds. So 4.581% for 30 years, pretty high, because this is the last time we hit this was around the summer. You don't want to get back up here in near 5%. This is really not a good look, because as you can see, this is where the bottom was in the stock market when the bond. So I can look at the US 10-year actually. Also, because the 30-year, you'll see that spill over into mortgage rates, and mortgage rates are was above 7, right? I believe they are for 30-year. Let me see what the fixed rate mortgage rate is right now. Yeah, national average is 6.74. So yeah, it's almost 7%. Okay. Yeah, let me see what the trading economics says. Yeah, 6.72%. That's the last reading. You don't want to get up to 7. If this thing hits higher, yeah, it's gonna hit 7. You're gonna crush the housing demand. It's already getting a little pressurized. Let's say that. Okay. Yeah, I definitely don't want to see that. So TLT below the 92 area, you don't like that. You do not want to see that. This better bounce back up into the blue area and try to stay within this range before continuing back up here. So for the rest of 2025, you want this to climb back up here, and that will be good for the overall stock market. Yeah, that's about it for that. Okay, guys. Now let's see what the next video is. I got Intel. So this one, it will be an interview with the Intel CEO. So Intel did all right. Oh yeah, let me show the chart for Intel. Yeah, before we go on here. Yeah, see, not bad, not bad. It was 11% to 12% in after hours on Thursday. So Thursday evening. So it tried to do that, but it didn't make it there. So we're still above the cyan area. So that's good. Okay. So this cyan area where I put 2 lines, you want to stay either in it or at least 50% of the upper range and above it. That's a good sign. If it starts hanging like below it or at the bottom half of the two lines, no. Then you're gonna have to. Yeah, you're really testing people's patience. There's gonna be panic selling. I'm not sure if that's gonna happen right here, because the market, I don't expect to really crash, but you never know with the elections coming up. If they can't figure out who's president, this and that, the news media and Jerome Powell says something bad, yeah, you could get a temporary short-term breakdown. And that's when people start getting scared. Get ready to buy. So if you need a stock for long-term holding, Intel is definitely a blue chip to get. Boeing is definitely another blue chip. And I've heard NVIDIA is getting added to the Dow Jones. So NVIDIA is right here, almost at the high before its earnings. Who knows what's going to happen? And it's replacing Intel. So they kicked out Intel from the Dow Jones 30 stock index just after the close on Friday. That's news. So I have no idea what Intel will do next week, because getting kicked off of there means a lot of ETFs will replace Intel with NVIDIA, and that's going to put downward pressure on Intel already. So watch for that. Watch for where it will go. So it might not even stay up here above this top blue cyan colored line. It's going to go towards the bottom again, and that's when watch for it. So it would be a cheap stock you can get. If you do options, you can get leaps, I suppose, if you're really aggressive, but don't expect a quick turnaround. This is going to be just like GE. So if you know GE, this was such a garbage stock for so many years, since 2018. Terrible, terrible stock, right? Like it goes up, but it's temporary, it comes back down. So this range here was years in the making. So from 2018 to 2022, before it finally got back up to the old highs of 2016. Things like this don't turn around fast. Intel is a fat company. It might have to do what GE did and split into multiple different companies. I think that's what's going to happen. But obviously, it's not going to go bankrupt. The U.S. government will probably save it if it ever gets to that point. And yeah, I highly doubt it's going to go below 10. But I'm not going to say never. You're going to take a chance by buying it here, because that might not be the final bottom, all right, for Intel. So that's why I keep warning people. It's like, yeah, you can start buying, but you're going to have to wait a long time for any returns. And you might have to go through an economic recession for it too, because I don't know, right? After 2 more years of the stock market, it might be that's it. We're in 20 years, nearly 20 years, 15 years at least, right, of a bull market, and you're going into 20 years. That's quite a long time. Quite a long time. Like here, let me show you. Let me show you like monthly chart here. Let's go monthly here. You see this channel that I drew? It's been doing quite well, right? So if I draw the tops here, I use the top line, I use the tops, top. So that's how you start drawing a channel. First, you draw a line. You probably use the tops, the recent tops. You pull it down, and I pull it down to here at the 2009 low. And interestingly enough, COVID, it dropped quite close to that bottom line. So you could say this is what they call the demand supply. So here you get the supply, you got the demand. This is where the line is. And in this area here, you see the COVID blow off. So from March 2021 up until January of 2022, that was the blow off. So this whole area here was just like extra innings. So even if you didn't know bad news was coming, you knew that, the clock was ticking. This is where we are right now. And yesterday, I believe it was yesterday morning, I was talking to False, and I told about the bubble. And what I mean by that was, I explained it in the last stream, was, we're at the point where if it keeps going up, this is just extra innings. It's just driven by liquidity. So it's not really anything that's tied to valuations in any sense, because when you have something going that way, you're overbuying overvalued stocks. And the only reason it's going up is because people have the money, either through margin accounts. If you look at the margin accounts, how much money they borrow from the bank or broker to buy more stocks to increase their positions, or it's because, yes, there's injected liquidity. And I was talking to him about, like, well, if you look at bonds, we know that interest rates for the T-bill. So if you had a T-bill or a CD, they give you 5%, high interest rate savings accounts. So that's very attractive. And it's a guaranteed 5%. This is over a year. All right. So obviously, if you buy the S&P 500, you should theoretically beat that. But because the S&P 500 is not risk-free, we were talking about risk. Buying bonds is essentially riskless. The only way, okay, I'll give you a caveat. Only way that a bond is not risk-free is if there's something happening where the interest rates, like what happened in 2022, where the interest rates stay high. And when it starts staying high, the Fed funds rate stays high, then the long end of the bond, the yield curve, okay, we kind of mentioned that a few times. The yield curve stays in a way that people just do not like bonds anyhow. And then you start bonds dropping again because they want higher interest rates, just like with the TLT, like I showed here. Yeah, see? So, it's a trade-off, man. So bonds are not technically riskless. I kind of mentioned it a few times. So even if you got interest rates, you got also inflation. That's another risk, right? The inflation stays high, then bonds don't look very attractive. Then you got to look at gold. Yeah, see, that's why so many things come into play, because everyone's like looking for where they want to park their money, and there's many reasons that you have to consider. So that's it. What's up, 12 man? What's up? Okay, so back to Intel. Let's see how that goes. Oh, could be an opportunity here to buy it at the bottom, and one day it will return to $70 set in 2021, which is also, I believe, close to the high of the dot-com boom. So you see here, Intel was quite the hot stock from 1986 to the 2000s. After that, it just went sideways. Why? Because first of all, during the era of the 2000s to 2008, that's when gold did well. Okay, tech stocks did not do well. And even after the great financial crisis in 2007 to 2009, even though it went back up, you can't compare it with something like Nvidia or Apple, because you see here, so if you do 2008 to now, no, it didn't compete. That's the problem. Intel, yeah, it's a solid business, but it's not growing anymore. That's why you see this motion. Nobody's willing to overpay for this thing. Nvidia, they're definitely willing to overpay. Nvidia is way overpriced compared to what it is. But why are people paying for it? Because they know there's growth coming. Every year they know they're growing, because here it was just gaming, right? Okay, Nvidia sells graphics processors for gaming. That was what it was doing for so long. But you go into data centers, you need increased processing, right? For what they first did was they went into scientific computing, but eventually they targeted AI, and that was appropriate. So these guys were smart. They moved their business to where the growth was. Intel missed out. The first mistake Intel did was it didn't compete with ARM. All right. That, I think, yeah, one of these days I got to do more of the semiconductor streams like ARM. Oh man, I wish ARM didn't delist. Oh man. Because ARM used to be a public company. It got delisted when it got bought out by SoftBank. Now it's relisted. If I showed an ARM chart, oh man, I wish I had a historical ARM chart. I don't think I could get it from TradingView. I mean, yeah, shoot. Because if I showed ARM compared with Nvidia in the past, and you look at the stock, you could see that ARM was eating their lunch. Okay, ARM went into every phone. Every phone had to have an ARM when they did smartphones. Intel, they were approached by Apple to do the iPhone, to put their Intel processor, and the old CEO said, nah, we pass. We don't see any future in your smartphones. Really dumb. Really dumb. This is how companies fail. You have a culture issue. You got CEOs that don't have vision. They're not willing to take a chance, a risk. So having the right CEO is critical in a tech company, for sure. I mean, any company, but for sure a tech company. Okay, so that's how companies die. Dell is kind of the same way. I remember the Dell CEO, used to laugh at Apple, and and during the 90s, because Dell was competing so well against Compaq, Apple. They were ruling the PC business, and they went private because Apple, when Steve Jobs came back, whooped their ass. You just, in the tech world, everything changes so quickly. You just have to have the right mentality in the CEO just to compete continuously. You're always competing. So that's something to say, because that's how I made my money, was tech investing. So that's why I know it so well. Like, because when I looked at a stock, it was before I did charting. So I'll tell you this. I never looked really at charts. I was always a long-term investor, and I've only been doing this trading stuff recently. So that's why I don't like to speak on experience like Denizen or CKJ3 or anybody like that. But I've watched a lot of videos and read a lot of things to back up what I've watched, because mostly I've watched videos of people and I track them. I tracked, like, okay, this guy tells me this is the technique they use. Okay, let me see what they pick as stocks, and let me see if they verify that these people actually know what they're talking about. So there's very few people that I believe in when they talk about charts. Very few. But before I was doing that stuff, I just looked at CEOs. That's how I'm looking. So AMD was one of them. They had a new CEO, Lisa Su. I think she came in around the 2014 era, around here. So these were bad times for AMD. They could not compete with Intel. But they changed their ship, and guess what? Since buying it at $2, $3, $4, it did quite well. But I sold early because there were better stocks to get into in the 2018. So I sold around here. 2018. Yeah, this was the last time I was in it. So I could have kept it and it would have went up again. But there's so many other stocks to choose from. So even though it goes up from, let's say, 15 and 30, so if I bought again at 15, sold here, no, yeah, going over to something like Nvidia or something else, it would have been better, right? So you're always constantly looking for something better. So that's where the charts come in. Charts are really good at trying to summarize where you want to be. That's really what I'm trying to aim for. And that's why when I do my scanning, I go through different sectors and things. I'm trying to look for it because, like, yeah, you could have been in avocados. Maybe avocados would have been the thing to be, or something else. Because around this time, you could have been in soda, energy drinks. So let's say Celsius, right? Celsius Holdings. You see here? Of course, I didn't buy down here. Okay, I didn't buy this. I didn't buy this thing at like 7-8 cents, and then sold it at 60. I'm not that good. I mean, I bought it around here like $1 or $3 or something. Like, yeah. But let's see, right? Switching over from AMD to something like this in a 2018 era, like it would have looked dumb, right? If I switched over right here, I said, okay, I got AMD. I switched over to this stock. Okay, it still looks dumb because AMD probably was still going up until COVID days, right? Well, you can look here. Yeah. Okay, it was still going up. It's still going up because it lost. Let's say I was really good and I sold up here, right? And then it dropped back to 15, 17. I could have bought back, but I chose not to, right? And then went somewhere else. So if I used that money and went to like soda, because I see this huge range here, I would be like, all right, I'm willing to take a shot because this thing's been going up from a range from 2017 to 2019. I don't know where COVID's coming in, but I'm holding. And guess what? It goes from $1, $2, $3 to $33. That's 10x. That's way better than what happened if I did AMD. So this is what we're gonna try to do. We're always constantly looking for the next big winners. All right, when we scan. So that's why the past presentations I've tried to introduce some scanning. So that's what it is. All right. So let's go to Intel. So that was a little bit of a divergence, but let's go to Intel and see what the CEO is saying.
Gone, we were just talking about how you made painful decisions and those showed up as impairment charges and were reflected on the bottom line. To start, could I ask if that's it now, that those actions are taken and you now have line of sight on what you want to do, or if there will be more sort of restructure to come?
Yeah, we worked very hard this quarter to get this done. And the people actions, the restructuring charges, largely finished this quarter. So it was a challenging quarter that way. But to also deliver better than expected results if we eliminate those one-time charges and to take our guidance up for Q4, I'm very proud of our team being able to do both of those this quarter. Some of the most difficult restructuring charges maybe in the history of Intel since our memory microprocessor decision almost 40 years ago. Getting that done and still beating results and taking the guide up. This was a very significant quarter for our team to execute. Very proud of their disciplined results.
Pat, the investor base are cheering you. I'm going on the reaction of your stock in after hours, but a lot of that does seem to be a focus on what you were guiding to in the final 3 months of this year. Away from sort of the financials and numbers, could you talk a little bit about the product business and the foundry business that gave you some confidence in that guide?
Yeah, and if we take it apart a little bit, the client business, we've launched our Lunar Lake product, the second generation of our AI PC, and the AI PC category, very solid. We'll be launching the commercial version of that into a good market, we believe, next year for a Windows refresh, a corporate refresh cycle, and we start to see more strength in the AI PC category overall with strong set of use cases and ISVs bringing new software into the marketplace. So we feel good about the client business. Data center quarter on quarter, a little bit better than people forecast for that business, and a stronger product line with our Xeon 6 products now starting to ramp. And finally on the Intel Foundry, quarter-on-quarter growth in that area and a strong pipeline of external customers. We announced Amazon and 2 other 18A customers, some additional advanced packaging customers. So we're starting to see that business come to life. And that's a long-term business because when people move designs, it takes several years for major designs to move into our foundry. So we've been at it now a couple of years, and we're starting to see the results of those hard work and getting back to competitive process technology with 18A. So a very good quarter of operational results.
Pat, we have a question from our audience, and that question comes from Clem DeLong, who's the CEO and founder of Hugging Face. And he makes the point that on his platform, there are many more smaller models now available. And it's leading him to have a question for you about Intel's place in the on-device trend we're seeing with AI and how you're going to enable more on-device AI use.
Well, thank you, Clem. A great question. And Hugging Face, a great company. And, as you think about these models, we do see it moving from the training phase of, trillions of parameters to the inferencing phase. And exactly like the questioner says, in that inferencing phase, more of that will happen on-prem for data center customers, and many of those smaller models will be retrained with enterprises' own data. A lot of those will just run on Xeon. We don't need a special accelerator, or it'll be Xeon plus an accelerator. But also then the edge use cases and AI PC use cases. And I call it the 3 laws of the edge, right? The laws of physics, right? Speed of light. If I have to go to the cloud, I add time. Second law is the law of economics, right? It's cheaper to run it on my device. And finally, the laws of the land. My data on my device in my data center. So we see it moving from a cloud training world to an edge and on-prem world for inferencing for the future.
Pat, I therefore have to ask you about Gaudi. Your AI accelerator did not get the traction that you'd hoped, and you won't be making the outline target of $500 million in sales for this fiscal year or calendar year. Why? Is it a use case issue that the data center operators aren't looking at it, or something else?
Yeah, two factors that we pointed out. One is that now we have Gaudi 3 coming out, so there's more enthusiasm for the next generation product that we're just starting to ramp now. The second one is the software. And the software use cases, the AI world has moved very rapidly and innovating very quickly. And the robustness and the completeness of the Gaudi software stack hasn't been as great. And it's an accelerator, not a full reprogrammable GPU. So that makes some of the software porting and optimization a bit more difficult. Obviously, as we get more of that running on Gaudi, we solve the software problems.
Okay.
But secondly, then it's also to move to a complete GPU capability, which we'll be doing out in time. And that development effort is also well underway. So we feel we have a solid position. The world is coming to more on-prem and enterprise use cases like the last question asked. And Gaudi 3, good early indications from the marketplace and its success as we ramp it in 25.
If you're just joining us on Bloomberg Television and Radio, we're live with the Intel CEO, Pat Gelsinger. Pat, Bloomberg's reported that ARM and Qualcomm, two of your peers, are interested in buying some or part of Intel. Can you confirm whether or not you received a formal offer from them or anyone else, and what Intel's consideration of them would be?
Yeah, and obviously there's been rumors and churn in the industry, and I think all of that just indicates how important Intel is to the into the industry structure and semiconductors, and how important those supply chains are, for the world. We don't view any of these rumors as particularly meritorious. We, laid out a strategy. We reaffirmed that with our board of directors, and obviously as we've taken these steps this quarter and restructuring and getting our costs where they need to be, we have the capacity to go on the journey that we've laid out, to produce sustainable profitability and result in shareholder return. So with that, I'm committed, the team's committed, we have the board support for the strategy that we've laid out, and Q3 shows that's exactly what we're going to do.
Pat, I've been trying to help our audience understand Intel's historic and current business, right? The products, but also foundry. And what you said was that 2026 is when those third-party customers start to show up. But could you just outline the path to that? What you want to hold yourself to for next year in developing that business as a sort of standalone unit?
Yeah, and it's a great question, Ed. And clearly we started to see that already emerge. And even this quarter, we saw quarter-on-quarter growth of the external foundry business, largely driven by some of those early packaging design wins. So these advanced packages are sort of a faster on-ramp. But ultimately, it's becoming a wafer foundry for the industry. And as we said, three major design wins this quarter, one with Amazon and two other compute use cases. So we'll be updating, the market as we win more of those customers and describing the lifetime deal value of those to the marketplace as well. So we'll give some of those breadcrumbs along the way. But it takes a couple of years for people to move these designs, a year to design it, a year to bring it into production, until it starts to ramp in the marketplace. So key milestones for 18A, that customers are now beginning those design cycles. The design tools, the design libraries are being moved over to 18A. But it really isn't until 26 that those results start to really help Intel's products, and then 26, 27 until we start to see meaningful volumes externally.
Pat, we're just days away from an election in this country. And I'm particularly interested in your assessment and planning for what might happen to the CHIPS Act programs. Of course, I don't expect you to know what will happen in the election. You do not have a crystal ball. But former President Trump has kind of made disparaging remarks about President Biden's economic agenda. How are you planning for that, please?
Yeah, and I'd say maybe three different perspectives. Number one, the CHIPS Act was a bipartisan act. And with that, strong support from both sides of the aisle. And with that, we believe the importance of that in terms of industrial policy, the semiconductor industry is well supported by Congress and both parties. Second, we are disappointed by how long and how slow the dispensing of funds has been. And it's well over 2 years at this point. I've invested $30 billion in capital, and we've seen $0 of the CHIPS grants at this point. So we do believe that that has been too slow, and we're somewhat frustrated by that, and we've taken it out of our financials for this year. That said, there's also the investment tax credit that we are seeing, and it is much larger than the grant portion of the CHIPS Act, and that is now law, and that will be beneficial. But clearly, I think whoever wins the election, the importance of this industry, the importance of rebuilding this supply chain and manufacturing is well supported. And Intel, as a designer, R&D, and manufacturer, is unique in the United States and in the overall structure of the industry. And we expect the broad support, right, of the administration, regardless which party wins, as a result.
Thank you. Pat, 2 quarters ago, your CFO told me you were too over-indexed to CPU. And we know what happened with Gaudi. You made painful decisions in the quarter gone, reduced headcount by 16,500. Do you now have the plan in place? And are you confident from here?
We laid out a clean sheet program that we went through to really benchmark the business. We took a conservative view of the funding plan, as we call it internally, saying, we're taking a modest growth outlook and we're building our cost structure to that very modest outlook. But we've also built now a lot of optionality to scale up into the business. We have a shell ahead, right? We have capacity that we can scale into if necessary. And we've made a smaller, more efficient, nimbler company that is able to execute with more agility and speed as well. So we feel like we're now well set up for the future. This was a challenging quarter, for me, for the company, but we feel like we're well set up for the future, and the good operational results that exceeded the market's expectations.
All right, that was an abrupt end. I don't know why it ended like that. What's up, Jay Rillo? Yes, tropes. This is a really hard problem for people to figure out what their strategy should be. The first thing I would say is to build up capital, and that would probably require you to try to do it as much as you can with a job and getting raises and stuff like that. That's the only way to do it consistently before trying out different things. For people with a smaller liquid capital that they could set aside for trading, if it's too small, if you have a brokerage accounts that don't add up to more than $25,000, then yeah, options pretty much is the way to go. And if you're doing options, I think Denison's right. You probably just should stick with S&P. So SPY, yeah, SPY options, because you can't go wrong with that, right? If you mess up, the S&P will still go up in the long term. Because if you try to do it with individual stocks, picking individual stocks is a hard game already. And then the second hard step is to try to use ETFs, where you just rotate around different sectors and then use options on those ETFs. With CKJ3 is kind of says that he does, but he uses leap options. And yeah, we could talk a little bit about that. I'm not an expert on it, but I did pull up some examples of leaps for Mara. So that's the Bitcoin stock. The thing was, when I pulled them up, it wasn't actually anywhere of it didn't look like it moved any differently from the underlying stock price, right? Because it depends on the strike price. So because the leaps, like most of the leaps that are popular for Mara, apparently, I have no idea why in particular they picked $25. That was the one that was popular, and $50. Right now Mara is 14. It went up to 20, like close to 20 around earlier this year. It dropped. So because it's below that strike price, it didn't really move very differently from the underlying stock itself. So the only reason I would say like, oh yeah, I would rather buy a leap option in something like Mara would be because, all right, I think in the future it's gonna go shoot up to 90, and then that's it. That's really where I want to be. If I think Bitcoin is gonna shoot up to maybe 300,000, let's say, yeah, Bitcoin could do that. If we have that bubble situation I was talking about, we got a lot of liquidity. So yes, very tough to decide. Everything is such an individual decision. But even just sector rotating without options with ETFs is hard. It's very hard to beat the S. That by hard I mean being the S&P 500. You can make money, but if you make less money than just buying and selling the S&P 500 itself, the standard ETF for all the sectors, you can't beat that benchmark. Then what was the point, right? What's the point? Mara, Mara, yeah, to me, I just use it as a leverage way to trade Bitcoin. I don't really care about it as a company. Bitcoin mining I don't see how it's a profitable business. I don't think any of them will ever go anywhere unless they get into AI or something like that. Because if you're mining Bitcoin, you will not be successful as a business, right? With the fundamental reason that Bitcoin does not pay out as much each halvening cycle. So I don't see how that's a long-term strategy to make money unless government intervenes. That's the only way. If the US government feels like it needs to have a say in Bitcoin and support mining, because you don't want to have a bad actor. Like, you don't want it to be where someone says like, oh, well, I'm just going to control over 50% of Bitcoin mining computing power and just screw over everyone. That's how do I know it's only because of sentiment and momentum. That's it. It's just for trading. If you're doing it for investing, no, I wouldn't trust. Now, Rashu probably believes that because Bitcoin will be an essential part of life, then yes, it is a good, because eventually the government will intervene. Either they support these companies through government funding or they buy them out, right? Then maybe as a long-term investment that makes sense, but that's the only way. That's the only way. But as for trading, perfect. It's perfect. Yes, that's right. So for me, what I usually do is, and the reason I'm talking about it right now is because here, I'll show you. Because this is a good time to get in, because seasonally we are at a good spot. Because what I want to see is I want to see the NASDAQ move up, or at least try to stay sideways. Number one, NASDAQ. All right. QQQ. I want to see this stay up. Okay, that's the thing. Now, the last time Mara went up is around here. You see this area? So this is a good spot, because I see the NASDAQ drop to the moving average. All right. Second thing is I need to see Bitcoin, right? Let's see. Bitcoin was here. It was here in the moving average from September, August into October before it moved up. So I knew seasonally NASDAQ goes up. Bitcoin will go up for at least a month or two, at least a quarter. I got that. So this is cycles, okay? Because I'm talking in cycles here. You're trying to align the cycles together, because Mara is part of the NASDAQ group, right? Sometimes people will just buy whatever is in that same group, that same area, which is where the ETFs come in. Because even though I don't think any of those Bitcoin miners are in those ETFs, but they are in the same area. So anybody with money will just start investing in any stock that's in that same group. That's kind of like how meme stocks work too, right? So people were jumping between meme stocks for no reason. Like this got delisted. COS, was it COS Corporation? What the headphone got? Was it delisted? I thought it got delisted. No, somebody got delisted. One of those dang meme stocks got delisted. Like, why is a headphone company have anything to do with GameStop? But like, you see this? You see this? look at that. Look at that. Like, GameStop pops up here, 2021, again in 2024, and then you look at cost headphones. Look at that. Look at that. The same time. How does headphones have anything to do with GameStop? Nothing. It's just because people in their minds tie things together. So whether it's Reddit, it doesn't matter, because to me, rich people do the same thing, or anybody does the same thing, because they try to go after stocks that are in the same kind of quote unquote group. And this is kind of like a random thing because it's a meme. Like, meme has no actual like technical or fundamental reason they should be together. But when you look at Bitcoin related stocks, they'll move together with quote unquote Bitcoin, but they also move with the NASDAQ because they're in the same grouping of stocks, because that's how it goes. Technology is in the NASDAQ primarily, especially trashy ones. QQQ is like the NASDAQ 100, but there's the NASDAQ composite, okay? And NASDAQ composite is a way broader, IXIC here. You can look it up and it usually goes with the 100 because the 100 leads it. But they are slightly different, okay? But it doesn't matter. If you see the 100 top stocks move, then you should assume the trash will eventually move with it. Now, if you want to get down to the lower levels, you look at the Russell being the small cap. So I can look at IWM ETF and see. You see here, it's going sideways still since here, March 2021. All right, so we dropped along with the stock market, but went sideways again. We went back up. So essentially, we've been going sideways since COVID, right? I could draw another line here for you guys. So before COVID dropped, you see that? So small caps haven't gone anywhere for years. Now, what I'm telling you about that bubble is that if this breaks out and actually doesn't do this was a bad sign. This is how you knew the stock market probably wasn't going to do for the next year, because when this happened, it was November 2021 when Omicron, and so you had the bad news from Omicron variant of COVID right around that time, because people were just getting freaked out about Omicron. And then the second reason was that the Fed said they were wrong. They said, oops, inflation is not transient. We're going to have to raise rates. Now, the small caps got the message and they said, oh, hell no, we ain't going to break out. But if you looked at the S&P 500 or something at this around the same time, this was November, so it went down, but then it went back up into December. And then the last high was the first trading day of the year in January. I remember that day. That day was really funny. It just stayed there, but then the next couple days it started dropping like crazy, because I think what happened is that people kept holding stocks until the first trading day of the year so they could dump it, because you get a tax if you sell something on December before the year end. You have to pay taxes for that. So I think a lot of people made a ton of profit in 2021. They held out. They said, nope, we're going to hold it until the first day of the next year so we don't have to pay taxes for the tax year of 2021. And that's when everything started going crazy, right? This was way before the Ukraine stuff, because the Ukraine stuff happened here, I think. So that made it worse. But in any case, it was mainly because of the interest rates. But you can see the small caps sold off earlier. And you know why? Because if I looked at the XBI, which is biotechs are the most risky part, like I've been mentioning before, of the tech sector. These guys are so sensitive. So they made a high almost a year before. Like, so this was many months ahead of that Thanksgiving drop in the IWM. IWM here, you see, has both growth and value and all kinds of stocks that are small. But XBI is just growth. So it's mainly NASDAQ trash stocks. These guys rarely make money. They're just pharmaceutical biotechs that more likely than not go bankrupt. If they don't get bought out, they go bankrupt. That's it. Most of the time, that's what happens. So you see this top. This gives you an indication. I think if you look at Kathy Wood's arc, Kathy Wood, same thing. Because she did the most risky stuff too. But she not only did biotechs and whatever, she also did SPAC stocks. So a lot of SPACs. So SPACs. Maybe I'll talk about it later in this stream for you guys, what a SPAC is. Because I remember I had to explain it to HB a little bit. But, you know, maybe we should go more in depth. But as you can see, right, this thing started dropping really badly in November to December. So the reason why is because these are losers. So people were selling this into the New Year's because they wanted to cancel out their winners. So if I was in the SPY stocks, they generally went up, right? The SPY is 500 good companies. In general, these are the best performing companies in the United States. Now, if I had a bunch of risky, trashy stocks that did not perform well anymore because the high was here, let's say there's a bunch of idiots. They bought here in February 2021 at the high. They bought everything that was bad, and then they just sold off. And so they were already in the red. So by the time November comes, they're thinking like, you know, they're over Thanksgiving. Usually that's what happens. They go over Thanksgiving, they meet their friends, they meet their family, and then they get chewed out, right? They're like, why'd you buy that stock? Hey man, you're losing money, blah, blah, blah. And then they get conditioned to be like, well, all right, maybe I did something bad. Maybe their wife like does their finances and figures out, hey, you better sell that stock so next year we get a tax break because we want to cancel out all your winners with your losers. And guess what, right? They come back from Thanksgiving and they go like, oh man, maybe they're right. And then Christmas comes and then they got to buy presents for the kids. And then they start panicking even more when they see the stock goes down. That's exactly what happens. That's exactly what happens. All right. Okay. Do you hold any Magnificent 7 ETFs? Yes, QQQ has most of, or if not all of them, I believe. No, I don't try to hold any FANG ETF. That's what they used to be called. I don't think there's a point. You could just buy them individually if you think, but the only Magnificent 7 that stock that really just keeps on going is Nvidia. Yeah, that's it. So anyway, going back to the scalping, the volatility and all that stuff. If you just look at this XBI, I want to see this breakout. Okay, out of this range. We've been stuck here. If we can get up to here above 119, okay, so we go from 100, about 100, 195 or 100 area to 119 plus, back to 140, that gives me a good indication. Okay, so tomorrow. No, yeah, I do it manually, tropes. Yeah, I do things manually. So what I do is I just use this Ray tool. Like I mean, I hope there's some AI thing that can eventually do this. Like, let's say, yeah, see, you just do that. Like, you can do stuff like that. That's what I do. So I use the Ray, horizontal Ray, and I just go boink. Right. See. And you can see this one's pretty interesting, right? You go from this last major high in 2014. You see these bottoms here that kind of get close to it. Yeah. It's this one. These bottoms probably were caused by this flash crash. I have no idea why there was a flash crash here, but if I remember correctly, the 2015, 2014 era of stocks was volatile because of something with the Eurozone. I think there was a Eurozone crisis during that time. So there was a currency issue, and that probably caused volatility in the stock market in the end. So yeah, tropes, I used the 18 and 40. This is what Joe Rabel used, and I'm going to go over a lot of Joe Rabel videos. So if you are interested in his, and this has to do with the fractal discussion I did last time, because if you use 18 and 40, what he found was that if you do the weekly, the monthly, the daily, the hourly, it just works. And he claims that it just works on any time frame, honestly. So if you do something odd, like you do crypto, and for me, I use like 4 hour, and then 50-minute or something like that, and go to 7-minute, it still works. So for some reason, 40 and 18 is really nice. It just really just works everywhere. So you don't have to adjust your moving averages on any time frame. 18, 40 is just the way to go, what I found. So I'm sticking with that, because you can see like it touches it real nicely. And then when they go parallel, you don't need to draw anything really. Like this move up here, like I could have just drew a channel, I suppose. Like let's say I picked this high or something and went up here and did that. I didn't need to draw that. Like you see the 18 and 40 go parallel, then you know, like, hey, if you touch the 40 or the 18, and the way you touch it, that will determine things. Like here, you see all these red candles, boom, 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 in March into April 2018. This was a steep drop. So when it comes into the 1840 area like that, you know this is a bad sign. It doesn't mean like it's just gonna crash right through it. All you're saying is that from here, you know that because there's a double top here, you know that there's gonna be a change. So the next time it goes up, it's probably the last time, right? You see this? It tries, and then it just crashes. Yeah. So this is how you treat it. So when you see it move like this, and then it touches the 18 very lightly, like it pulls down and then it returns, pulls down and returns. Like if you look at these candles too, you see a lot of people buying it up because it doesn't close it. So this is weekly. This is a weekly chart. So this is actually quite long term. But when you see it like this, well, you see a lot of weeks where it just goes right through and slices through. And then I can just go to the monthly, right? And look at the same thing. You see that? This is smooth, right? This is really smooth. So then when I go up here, this is a problem, because once you do this on the monthly, you can see it changes. So that's why it's fractal, because here I'm looking at 2015. And I know it did a deep cut. I know that it doesn't mean it's going to crash anymore, but what it's saying is that the next time it moves up to this area here, so I could just draw another one here. You see that? I'm going to be cautious because I already saw a lot of damage before. So I don't presume that it's just going to shoot up and continue this trend. This trend is dead. So this trend from 2011 up here has died. So the next time it moves up, I'm going to assume, yes, it will be the end, the final end of the trend, and then go. So from this point on, it went sideways into COVID. And look how perfectly it's just going sideways from here. So because I know the trend is probably ended. So if I traded this move to this area, yes, I would have been out. Or at least if I stayed in, I would have been cautious. I would have been like, oh, all right, any sign of disaster will be gone. So then I would just go down to the weekly and say, hey. So I know the monthly was like that. So here it was going down and went back up. So here you see that this was a little mini trend on the week. So when I saw this, it aligned with when I was looking at the monthly. I would have said, all right, I'm out. That's it. So I'm just using 2 time frames, right? I'm just using month and week, but I'm using the same moving averages to guide what I'm doing. So that's why it's so beautiful. When you look at it like that, it makes so much more sense. Like you can see like, hey, I'm not going to make a trade anymore on the long side. I want to wait and see. So once COVID hit, that was your time to get back in, and you got this. But this was not a continuing trend, because once it failed here at this week and started going sideways, and then you see here in November when we had November 21st, when the Fed changed, you had Omicron, and you dropped below this area, because once you set this, because this bar here, this green one, was very significant, and you already went well below 50% of this body of this candle, then you know bad things were probably going to happen. It's not, none of this stuff means like I can predict the future. All I'm saying is like the odds of it going back up just went way low, and it's not worth it. That's it. All you're using charts for is not a guarantee of prediction. All the charts are telling you is like it's not likely anymore. So you're just trying to get the odds of a trade just looking at the chart. That's it. No. You just make your own tropes. You just use a moving average. Like you just get 2 of them. So you just get an SMA, right? You just use a standard SMA. That's free. Okay. So you just go here. What was that? The blah, 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 right? You just go SMA, and it's built in, right? You just do 2 simple moving averages right here. Yeah. Moving average simple. That's it. That's all you do. Yeah. So you don't need to do anything. I'm not doing anything fancy. Nothing I do is fancy right now. I mean, unless I do DeMark indicators or something like that. DeMark indicators, then I'll do something fancy. Okay. So that's what I hope you understand, that what I tried to do. Maybe I gotta be a little bit more clear and cleaner with the charts, or I'll put up 2 charts side by side so you can see. Maybe I'll do it again another way, but I hope you understand. So this is month. Every candle here is a month. I see this, and then what I do is I go week. Okay, I go to a week, and then I do the same thing. Okay, so what you saw in the month was like this big drop here. And then what happened was, okay, I know that this is a very damaging drop, but once I see this try to go back, I would make a trade here. I will probably get a long right here, because once you see this huge green bar above this support area that I drew here, you've been like, okay, I'm in. I'll buy. I'll keep going. And then I'll start thinking about selling when I reach this again. And the reason why is because when you look at the monthly, this was such a damage to that chart. And you see like the 18 just squeezed down next to the 40. The trend is gone, right? The trend is over. There's no more trend on the so you just add 2 of them, tropes. Now, if you're using a free version of Trading View, you might be restricted to how many, because back in the old days when I was using the free version of Trading View, they allowed at least 4 indicators at once. Maybe now they don't even let you do 3 or 4. Maybe it's just 2, or they're trying to make people pay, right? They're gonna restrict as much as they want in the free version. Yeah. Oh, you're using the pay one? Then yeah, you can do whatever. You can do an infinite number of them. But 18, 40, that's it. That's all you need. And it works on any time frame, apparently. That's what Joe says. So I'll stick with it. I mean, he's been doing this for so long. He probably noticed that 18 and 40 just works so well. Now, most people would use like 20-day, 50-day, like 200. And then when they go to weekly, they'll change it up, right? I don't like that. I hated that system where when you did different time frames, you had to tune it to whatever. You'll understand why the 18 and 40 work so well when I show Joe's videos later in this stream. Because when he uses it in combination with the MACD, it's just like, oh man, I need a system like that. So you can use whatever system you want. I just want you to show that if you can come up with a way that's general as possible, like it can work in anything, that saves you a lot of time. You just don't want to change so many parameters and things. You just want everything clean, okay? As simple as you can. So that's why when I look at things, I just look at the AT&40. Basic. You don't even need the MACD, to be honest, because you could just look at these moving averages and you could already tell, like, oh, okay, this is what's going to happen. This is what's going to happen, just based on how it's moving and based on what the candles are doing. So you don't need the extra indicators. The extra indicators are just there to confirm what you're already seeing, because most people, like, they just won't have time to analyze so many candles. That's why AI would be so advantageous right now, instead of just eyeballing it, because it's just like the fundamental people. Yeah. Yeah, I'm not really that good on trading view. Yeah, I just like to move it around. Tropes. Yeah. So definitely a lot of people need to be better at this. But for now, yeah, I'm just running around here. Oh man. So yeah, hopefully. So again, okay, why I was talking about this. Yes, XBI. I'm watching this. Watch IWM. Okay? Watch IWM. And then watch the NASDAQ. All right. All right. All right. All right. This is where we want to be. So all of them have to go up. And Bitcoin. So when I'm looking at these charts together, like, everything is set up right. Like, especially Bitcoin. Bitcoin is really nice. The way it make it this base. Oh my God. So now we go back to the chart of Mara. See, it's been building this range down here. So I bought some here when it went below 14, because it already dropped below 14 already. And I sold some when it got over 18 and a half here on this other line that I drew. Okay. So these two pink lines here. Now it's dropping. Perfect. Dropping right before elections and Powell. If it hits here again, just before Powell and right after elections, man, I'm going to load the boat for this last time. I want to see this. And then if Powell says good, sweet things Thursday, ooh, this still be rocket ship to 30 for the rest. Now, if he doesn't, if this thing keeps going bad, then what's going to happen, I assume, is we're going to have well, actually, there's earnings here too, so around the same time. So there might be some potential drop below here again. So I'm watching that. So let's see what earnings will do for Mara, and maybe that'll give a new opportunity to get in. The other one is CLSK, kind of similar in shape here. Yeah, it might be able to drop to, but it has earnings way later, so I don't know. It might not. But yes, I got to see it. I got to see everything together working. So this will be your next opportunity to get in. So that's why I told people to hold off when Bitcoin got to 7,200 into Halloween, which was exactly what I expected. Right into Halloween, it got over 7,200, pulling back. Worst case, it stays in this blue box. I wouldn't like that, to be honest, because then that means it will take a while until after Thanksgiving or maybe during Thanksgiving. But if it holds 65, damn, that's it. That's the buy zone for Mara and all that other stuff. So we'll see. I don't know. October has been pretty weird. It's not the typical October. October is supposed to be a bad month, but we've gone sideways in the S&P 500. Pretty much gone sideways. So after the drop, after earnings of Meta and what's his face, Meta and man, I forgot the other one already. Microsoft, Meta and Microsoft, and then Samsung was a surprise dud, and it crashed everything the next day on Thursday. So we kind of went sideways. So if you believed in the seasonality of things, where you sell Jewish New Year's, Rosh Hashanah, you had sold here, right? Oh, Friday, yeah, you had sold here, but it actually went up. So that's the surprise. Usually it would go down first into Halloween, into Sukkot. So that holiday, Jewish holiday, ended in 21st. But as you can see, like, well, we're back here now. So Halloween drop. So if you sold here, you would have been fine because now you can get back in. But this is not usual because you should have been going down into October and then buy into November, early November, and then get back up. Now, because it's doing this before elections, and this election is going to be pretty weird compared to most elections. I have no idea. Yeah, because you got to snap them. Tropes, and there's other ways when you, because like if you do multiple charts at once, then you kind of want to snap them in the same time range when you're looking at. So if you have a big monitor, right now I'm just on my laptop, but let's say you had 4 up at once. You had one on each time frame, monthly, weekly, daily, whatever. You kind of want to snap them all together. So that's definitely an important thing to advise people. But that's if you're a hardcore trader. You're really hardcore about things and you're looking at multiple things at once. Your eyes are probably going to be screaming at you. But, like this, see? Like right now I'm on a small screen. Okay, this is actually, but I have high resolution on this laptop, but still it's tiny, right? Like you put all your indicators and blah, blah, blah. And then you have to, so you kind of want to reset all the views, right? Like you said, Alt R, right, on each one. But if you're like doing it manually, just do that R. So see, then you could look at the cursor when you move it around. You're kind of like, okay, but yeah, you need some 4K setup, man. Yeah, you need some 4K setup. That'll be the best. But I'm not that type of person to be doing that. I'm really not. But if you're day trading and you're using multiple time frames, you better be pretty slick about it. You're not gonna be wasting your time going like, whoa, okay, scrubs. No. Yeah. That's hell. That's hell on earth, man. So I personally don't like that. But if you're a day trader, you gotta be organized, way more organized, because this is a mess to look at. Yeah. Okay. So again, Mara, CLSK, I'll definitely talk about it this week and many months because it's my favorite. It's one of my favorite stocks because I did it so many times. And you don't need options to get good gains on it. That's really the key. Like here, right during the COVID time, I didn't buy it down here at 50 cents. Okay, guys, I was not that type. I didn't really believe how dumb people would be after COVID, but I should have knew that with the Fed injecting money because of QE, plus people are staying at home doing nothing, have nothing better to do, right? They're not distracted. They can be glued to their screens all day. I really underestimated a lot of stuff that time because otherwise I would have loaded the boat on garbage like this because since I knew Bitcoin was going to go up because cyclically that was the time for Bitcoin to go up and the NASDAQ to go up, whether or not there was COVID or not, it would have done that. But because of COVID, you got that extra juice. So let's say you would have got in around here because this is where I got in around this time here, September to October, because that's where it usually the cycle starts. Okay. So if you got here $2, you would have got something at least 57 right there. Huge gain. Huge gain. Now let me see. Right. So that's about 2,000% right there for between October to April, right? Just before tax time. Perfect. Usually that's how it is. It goes to March until tax day for individual tax filers, right? So if I did Bitcoin around the same time, see how much I would have got. So yeah. Yeah, that was around this time. And then yeah, I remember this point was when China said they were banning Bitcoin mining here around that time. Also, there was something about the futures trading started to trade around that time. That was also news. So let's say October, September. Yeah, so Bitcoin only made about 500%. Around the same time Mara did 2,000%. See, that's why I did it. That's it. And if you were really a gambler and did options on Mara, and you figured out the right contract to buy, that would have been lovely. So we're at the point again. We are at this point again. Okay, where this thing can really fly up once more. We already did it once here. So this will be the last cycle. This will be the last chance to do one last big move up. I don't know how high Bitcoin will move. My targets are about 200,000 about, but that might be conservative, depending on how big that range will be. Because let's say Bitcoin doesn't really move much for the rest of the year and only will start moving into January, that'll make the range much wider. So you will have, so let's say here, from March to November, let's say this continues on until December. Yeah, maybe I'll have to change my outlook and go 300 or 350,000 for Bitcoin. And if that happens, then whoo, man, Mara, yeah, Mara will really fly up. So anyhow, let me actually show you this video from the Wyckoff guys.
Bitcoin here has returned back to the prior highs. This is what gold did, formed a big accumulation structure. And when it rallied up into the resistance of the 2021-2020 highs. And look at its response. The volatility is just squeezing out of this. It looks as though it's under absorption. Here it is, just marking time up here and not giving up ground from the rally phase that it had from the late 2022 lows up to this area. That to me is just a very bullish patina to it. I think this is very constructive and reminds me a lot of gold on maybe a slightly smaller scale, but still a very large time frame. So this is definitely a campaign orientation.
So here, let me show you gold. Okay, this is what he's talking about. You see, I just drew this right now, this box. This is the range that gold was in from 2020 to 2024. Now it broke out and it's just been flying ever since, right? This is perfect. Perfect. And I think gold, you know, people are targeting 5,000, whatever. I don't think that's impossible at all right now for gold. So when you look at Bitcoin, Bitcoin is just a more volatile version of this. Okay. So what we're seeing right now with Bitcoin is that we're just, like he said, it's on a smaller time frame. We're just seeing this area here. You could think of it as that range right there. This thing will break out and go higher. So let me go back. this. I think this one, let me see, it doesn't have a lot of history on this one. Let me look at the futures chart. Okay. You see this? You see this? So gold made this high in 2011. So this was the end of that gold rally. And I want to bring up Intel again because so Intel never moved anywhere during the time from the 00s, right? The aughts into 2018, because this point where Intel was dropping, which a lot of tech companies were not doing well during that the era of George Bush the second, not George Bush the first. George Bush the second was when commodities was ruling the roost. So commodities was doing well. So gold was doing well. Tech companies were not doing well. Okay. I'm not saying anything about like gold versus tech right now, because we're in a different situation. There are plenty of times when gold went up with the stock market, but there will be a point where gold will outperform the stock market, and that's when you better watch out. But we're not there yet. So just focus on this: 2011 to 2020. Gold was doing this base here, making this little cup, right? It's making a cup. And then it goes into a range. So I'll just draw here, right? And then it breaks out again. So when you take everything into account, this whole structure, this sucker, yeah, it can go up to 5K, no problem. And maybe even higher. But if you look at Bitcoin, look at the same way what it's doing. Look at what Bitcoin's doing. But it's doing it on a shorter time frame, like he was saying, right? So instead of 2011 to 2020, we're doing from 2021 to 2024. You make that old high, you make this big cup, you're in this range here for 1 year. So this cup is about 4 years. And you're a lot more volatile because here you go from like 63,000 to 33,000 and back up. Like this thing, and before it even got to the 2020, it was like at 5,000. This thing is a wider range. So believe me, there's a good chance this thing can fly pretty nicely. Pretty nicely. So yes, everything we're doing is momentum trading. That's it. Do I believe in this or that thesis or that fundamental? I don't know. Why is gold going up? Do you believe that the dollar will collapse or whatever? I don't know. I really don't care. People can analyze this any other way they want. I'm just here to tell you, if you're just here for trading, just focus on this, look for the patterns, and see the relationships. So that means people are buying and they're ready to break out. Okay, so notice. That's why the analog, they call it analog. They call it an analog. People try to look at previous charts and see if there's like common patterns. That's where the AI would be so helpful, because if you could notice patterns like these readily, then it shouldn't be a problem. It shouldn't be a problem to figure out where things are going. It doesn't mean it's a guarantee, though. I'm just saying that, you could at least get some odds. There's a higher odd or probability of something doing something just based on a pattern. And that's where the technical analysis comes in. And that's why a lot of people kind of related to cloud viewing. Like, you're looking for patterns in the cloud. This is why they call it the male astrology a lot of ways. But I think a lot of that male astrology is based on simple patterns. They try to look for, double top, like here. They look for cup and handle. They look for this and that. But none of those things really by itself mean anything. But when you look at it as a whole, like you look at the volume, what the volume is doing, you look at it with the moving average pattern here, because you see this, like this point is so perfect, because when the 18 kisses the 40 like this, when it kisses it, that's when you know the next big move is coming. So when you're in a long extended range like this and you have a kiss, it's just like here. You have this 18, it's kissing it now. It's kissing that 40. So what you expect is that you got to get the next big move up. Now, if I don't see this, though, that means it's over. This thing will just crash right down. That's the problem. You got to keep this pattern going. You got to say, like, it's got to try as much as it wants to stay above these lines here that I drew. So the above mostly the 50% of this range that's been built, you have to stay at the top, upper top of it. Okay, that's what you're looking for. All right. Okay, let's see. Man, okay, I was gonna play this Martin Shkreli video because I thought it was funny. I was gonna play it to the end, but maybe I'll just do it now for you guys, because Tropes was asking about options if he wanted to do it. It might be something that you should consider.
Can I teach you options? Sure. I should probably do a whole options course. People ask about options a lot. I think you should avoid options, to be fair. There's more and more options now, like daily options, that are toxic. If you guys want me to trade them like a monkey, I will. If you think that'd be funny, I can trade them, and you can see how some people try to turn $1,000 to $10,000 on the 0-day expiry. But I'm not any better at that than anybody else. I do use options to speculate sometimes, but not often. But yeah, if you want to see me try to monkey my way to $1 million from $5,000, it's going to end up the same way everybody else's ends up, which is losing all of it. So I don't believe in that. I don't think you should do it. I definitely don't think I should do it. It would be funny, it'd be entertaining, but I'm not here to entertain anybody or have fun. I'm here to do what I do normally, and if you enjoy watching it, then that's good on you. But if you don't, I suggest you go do something else, very politely. In the past, I would tell you something different, a little more aggressively, but I'm a changed man. I've been rehabilitated. There's a lot of books you can read about options. There's a famous book in particular. I wouldn't say that I hate anybody here. I just being honest with you. I enjoy the community, of course, but I'd be lying to you if I told you that, I'm going to do whatever you guys want or something like that. Oh, I got Grand Theft Auto to work, so that could be a total blast. Maybe we'll play that tonight if we get bored, or it's odd. Oh, I would definitely be role-playing. NASDAQ Capital? NASDAQ's live.
All right, that's enough. I mean, if you want to watch his autism, you can go find his channels. So that's from a clip channel. I put the link in the description. All right. I mean, yeah. I mean, it's entertaining. It's entertaining to watch people play options during the day, right? That's always fun. You see these things crash and explode in no time. Yeah. But Skrelly, man, the last video I wanted to play was fundamentals. Because he's a fundamental guy. You see what he was doing there? So while he was talking to people, he was putting every little financial information from the 10K SEC reports for a company into his spreadsheets. So if you've got a lot of autism, yeah, you can do fundamental analysis. I personally don't. The only autism I'm gonna do is with the charts. All right, that's the goal I'm trying to make. Make it easy for people. Anybody can look at a picture and just determine what a stock is gonna do. I really believe that. I really believe that. If you get really good at it, because humans are really good at looking at pictures, and that's why AI took so long to evolve, right? AI is essentially pattern recognition. You can recognize a pattern with a chart. You can do really, really well. Really well. Really well. All right. So let me get this. Let me get this thing. I don't know if I'm going to go over it too much. I don't have too much of an understanding. Let's look at this Investopedia article. How long is an options expiration cycle? Deciding to trade a stock option requires choosing an expiration date. Okay, because option strategies require making modifications during the life of a trade, you need to know a stock's option cycle and in what month its options expire. Now, the reason I bring this up is because leaps are assigned a January expiry irrespective of cycle, with new January leaps added in September of every year. All right. Okay, this is going to be important. Some stocks, if they are heavily favored among investors, will have options that are known as long-term equity anticipation securities, leaps. If a stock has leaps, then for more than 4 expiration months will be available. Leaps have expiration dates that are a year away or longer, typically up to 3 years. The expiry date is on the 3rd Friday of the expiry month. The contracts are ideal for investors looking for prolonged exposure. All right, this is key. This is key. So if you're using options to invest because you just want that added oomph, all right, that added leverage, then yeah, this is what you can use. This is what CKJ3 uses, and he likes to use it for ETFs and whatever. But last weekend, he talked about the ASML because I brought it up, and I played it in a clip of it in the last video. You can go back there, and he was talking about ASML contracts, leaps, and he gave some strike prices, so you can look them up and see if that's for you. Okay. So let me look at this thing here for Mara. So most active leaps. All right. Most active leaps. So one is going to be 2025 for December 19th, 2025. So that's 1 year away. All right. Let's look at it. Let's look at it. Let's see how it acted for 1 year. So the leap went from $3 last year to 20 or something like that, right? Yeah, it went up to 20, 17, 18, 19, 20. So I don't see much of a difference from this one with a strike of $22. So the problem is because probably because Mara never went above $20. So let me get the chart again. yeah, it didn't really get really far above 20, right? It went up to 28. So if I bought something at $7 something, $8 to 30, that's really not much different from $3 to $20 on a call option using those leaps. So leaps from this point of view isn't really much different from how Mara behaves underlying. Now, maybe those leaps would really do a lot better than Mara if we finally got to $50, right? If those were a 22 strike option, then I'm guessing so. But I'm not an options guy. Maybe this is the incorrect way, and I got to look at all the other little theta, gamma, all that Greek stuff that I don't understand. Because yeah, here's the chart. Here, you can go look at it yourself. Because yeah, one of the reasons I didn't get into options is because those textbooks are huge. So I don't know what Skrelly will recommend. Which book was he gonna recommend? But there are some classic options textbooks out there, and they are not fun reads. Let's put it that way. So I know John's into them, but John's a lot smarter than me, so I'm sure he likes that. So here, you see that delta, gamma, rho. Rho isn't used that much. Rho. Theta, very important. Theta. Vega. I think some people probably don't understand how to use that one either. So rho is definitely unused for most cases. Vega, delta. So delta, gamma, theta. So those three are the ones that most people use. If you're going to ask me to explain what the heck theta, gamma, delta is, I'm probably not going to say right now. But that gives you an idea of how complex things will be. So, and these are leaps, okay? So if you can tell that this tracks the price really well, that probably shows you that you don't need to learn what those Greeks are, because the way leaps are constructed is that they're so far away from expiration that these things probably won't figure into it. Now, when the expiration date gets really close, right, then you'll be like, fuck. No, I never tried any of it. I never tried any of it tropes. I know you mentioned it, so I can't tell you if it's good or not. And I see a lot of people have those cheat sheets. I have one. Let me see if I find it. There's always these options cheat sheets that people use. Cheat sheets, man. Man, I don't know where I saved it at. Man, because it's a pretty cool cheat sheet. I think most people should use that. Shit. Where did I put it? Options cheat sheet. Oh, here it is. Here it is. I think this is it. Oh, yeah. Yeah, you'll have fun with this one. Oh, man. Let me upload it. Let me upload it somewhere. Yeah, let me upload it. I can upload it somewhere. Guys can download it. You guys can have fun looking at that thing. Oh, it's in beta testing. Equalization filters, huh? What tropes? Are you into like DSP, digital signal processing? Or you just sound engineer or something? Yeah, so I put up the cheat sheet. You guys can have fun looking at that. Oh yeah, your music production, yeah. So you know some DSP stuff, filtering, yeah, because I'm an electrical engineer, so yeah, this is the same concept. I mean, I'm not saying options is the same concept, but yeah, I kind of know what's up. You got the band pass, low pass, yeah, equalizer, yeah, filters. I did that for work too. They did that for optical signals. You had to do a lot of that. So when you do, like for the data centers, you have those optical signals, and you have to massage the signal going into the you go into the A to D converter, analog to digital, digital analog. Yeah, it's probably a lot of stuff you probably understand too. It's a similar concept. So here we go. Novice, intermediate, advanced, expert. Oh, good luck. Yeah, I think you probably heard of these. Iron Condor, Iron Butterfly. Yeah, I don't know. Is this useful for people to be this basic? I think you probably have to know something in more detail, and then this is just a shortcut to for you to jog your memory, but maybe this is enough. I'm not sure, right? Is this enough for people? Like if you just read this, would this be enough for me to start trading options? I'm not sure. I'm not sure at all. Like the way Dennison put it to me when he started trading, it was just like he just jumped right in. And when he started losing money, he would just be like, "Oh, well, I'm not doing that again." But I don't know. The trial and error way, maybe that's not right for people. Ratio spreads. Yeah, this is really a whole nother game, man. But you won't need to do this with leaps. That's why CKJ3 he just buys the leaps. If he thinks it's gonna go up in the long term, then he'll just go for it, right? That's just it. But here, if you do short-term trading with options that expire in 1 month, yeah, you better know what delta theta is. Gamma is volatility, so that kind of is like a sucker punch thing where oh crap, volatility goes up. So even if the price goes the right direction, but volatility is the wrong way, you probably could still lose money, right? So it's not only the timing has to be right, the price has to be right, but then the way it gets there has to be right. So it shouldn't be just jumping up and down, right, going right into it. It has to move up there in a smooth manner or something. Yes, this is why. Whoo! Oh, there's a whole nother level of gambling. So you got to know a strategy. You have to make sure, you don't want to do this one, right? Covered call, limited profit, nearly unlimited loss. Where's the uncovered call? I don't know who does that one, but I know people who are really broke, they can't buy a share of Apple. They'll sell you a call for a stock they don't own. Isn't that the bad one? Man. I don't know. Let me see. Let me see if it's even uncovered call. Let's see what AI says. An uncovered call, yes, also known as a naked call, is a risky option strategy where the seller of a call option does not own the underlying security. All right, what are the risks? Investors with uncovered calls must monitor the stock for early assignment, which can happen at any time, but usually only when the stock goes ex-dividend. Oh, Lord, you got to worry about the dividend date? Okay. The seller also faces expiration risk, right? That's the usual risk. Many brokerages like Vanguard prohibit uncovered calls. Yeah, no shit. So what's the uncovered call versus covered call thing here? Okay. I mean, here it says the covered call strategy also has unlimited loss. So what's the heck's the point? Whatever. Like, yeah, I mean, you're just risky or more risky. You're still risky. Anyhow, I'm not gonna get into it. So you can look at it on your own time. All right. And here I'll just drop in some more links for you so you can look at it. Oh, that's the same link. Sorry, my bad. Here you can get to the Investopedia one with options investor with the expiration date, and I had another one here. You can look at this on your own. It's a nice frequently asked questions. I think here leaps and expiration cycles, like frequently asked questions. I'm not sure if this website is really the best one, but optionseducation.org. So, yeah, maybe that's okay, but you should read a book. Yeah, you should read a book at least somewhere. This is not something that I would just jump into with a cheat sheet. I feel like that. So, all right, let's continue. I had this video about macro outlook, so I like this one. Let's see if we can get through some more videos here.
Enbridge higher this morning, up about 0.3% after delivering an earnings beat in Q3 and reaffirming guidance into year end. The company specializes in energy pipelines and natural gas utilities, saying the macro outlook for demand has never been higher, driven in part by data centers. No surprise there. Joining us now in a CNBC exclusive, Enbridge CEO Greg Ebel. Greg, can you help explain some of this demand that you're seeing? Never been higher is a very strong statement, but obviously the data center trend has been one in focus thanks to the advent and growth in AI. How are you playing a role there?
Yeah, for sure. Well, it's actually really three secular trends that are really putting at the intersection for us of some incredible growth. So the first one, as you say, is AI, which is really about power, right? So natural gas, obviously being a key component of power production. Our renewable business, we're seeing that. Obvious data centers. We announced today the second segment of a renewable project with Amazon as the off-taker. We're just announced one of the largest solar projects with off-takers like AT&T, and then Duke and TVA taking gas. So that's a pretty incredible cross point there. Reindustrialization, that's driving the need for natural gas right across America, and reshoring. And then finally, not to be forgotten, is the exports. And we're one of the largest exporters of natural gas through providing LNG facilities, and the largest exporter of oil in South Texas. So all three of those secular trends really gave us a great 8% growth in our earnings over the quarter from a year ago.
So the demand picture is clear. How would you characterize the capacity constraints? Because we've heard that from several people kind of downstream with regard to power in particular. What does the market look like in terms of the ability to actually supply this demand that you're seeing?
Yeah, great question. Obviously a challenge. One of the benefits we have at Enbridge is that, we've been here for 75 years. A lot of these pipelines are in place. We have renewable projects that we've been working on for a very long time. So we've got $27 billion backlog of all of our projects. So it just depends on where you are. If you're in great jurisdictions like North Carolina or Ohio or Texas, places like Ontario and Alberta, then you've got an opportunity to actually really make a difference. markets. And you see data centers, you see reshoring going to those types of places. So it really depends. But if you're just starting out and you see this with some of the data centers and you're trying to find a place, you're going to have interconnection problems. So we really like being the incumbent player in this regard. And that gives us the opportunity to have some real nice tailwinds with our growth.
One thing we keep asking folks, Greg, and we asked Lisa Su this about energy supply in the coming years, is everyone's talking about it, right? We know it's a problem. It could be a crunch. But the fact that we're talking about it, she argues, and given the genius of our engineers around the world, the fact that they're thinking about it already at this stage maybe is a hopeful sign. I wonder if you think that way.
Yeah, I think that's true. I think there's one wild card here, and that is permitting. And, you know, you often hear that in many industries, Carl, but permitting when it comes to energy infrastructure, and it doesn't matter if it's in our renewable when it comes to energy infrastructure, and it doesn't matter if it's in our renewable business, it's in our liquids business, or just gas to people's homes. That permitting challenge is one that we've got to get over. So there's no doubt we have the supply. There's no doubt that we have the technology and the skills with engineers, et cetera. Do we have the will to permit this stuff? And so, you know, we'll see a new administration of one type or the other a week or so from now. And that permitting, I think, has got to be top, front and center for any new administration, and we've got to get that right, or we won't be able to get this supply to demand markets.
So, as you mentioned, with the administration next week, of course, is the election, and there is some overlap when it pertains to nat gas policy. But I'm curious how you're planning your business in light of next week. Would it change if there was, you know, a Harris in the White House versus a Trump in the White House?
Well, one of the benefits of being here for 75 years and being in 43 states, 5 countries, 8 provinces, and Ontario is that we work with all different stripes. 1, 2, everybody needs energy. And I think no matter whether it's a blue or a red administration, they need that energy to drive the economy. They need that energy to get to the markets if it's going to stay cheap, reliable, and even from a foreign policy perspective, right? The United States of America, with the help of all the resources in Canada as well, has an incredible geopolitical situation. So from my perspective, it's not really who's in the White House. It's really looking at all the administrative branches and the executive branches and the legislative branches at the federal, state, and provincial level. And we've got to find some coordination to be able to get there. I'm optimistic. Again, maybe that's because we've got so many pipelines and facilities in so many locations already.
Yeah, bringing that Canadian optimism as well, perhaps, to the conversation.
Righty. Well, we had earnings on ExxonMobil and Chevron. Now, sadly, ExxonMobil lost most of its gains during the day. So that's Enbridge. That was a CEO talking. That was Enbridge here. ENB. That's a ticker. Now, Chevron. Yeah, it popped pretty nicely, but ended the day at the low end of its open. But ExxonMobil, so Chevron is CVX. ExxonMobil, yeah, it lost all its gains at the open. So that's annoying because, you know, I was in oil. I was hoping this was a start of a new trend up, but back to where we started the week, right? Around $30 a share. We're still stuck around there. Then that means it's elections. It's going to be elections time. Yeah, so a lot of it will be energy, yes. And I think the easier play is utilities. Like I've been telling people, I've been talking about Hawaiian Electric because it's just a dumb, easy play to make. I mean, I made my play here when it went below 9. Pumped up to 18. Actually, I made a joke about shorting it here, but you know, I don't short. But if anybody listened to me and shorted here and waited until October from July, that would have been good money shorting it. Now we're back to 10, and I think Citadel is in it. Citadel, the guys who were shorting GameStop is in it. So it's doing its move. I like this chart, right? You see what it's doing? Going from 9 to 10. Maybe it'll break out soon. The other one is PG&E, Northern California utility. Actually, it has some news about overcharging people. So it owes like 800 million in over. Yeah, I have no clue how that's gonna work out. Are they gonna have to refund people now? All I know is like they're making hand over fist just overcharging people in California. So let me see. PG&E. Let's see, overcharging people. Yeah, PG&E sitting on 830 million in excess payments. So no idea if they're gonna pay that back. Interesting. Okay. Yeah, they're allowed to overcharge. It's legal. Oh, okay. So yeah. So like I said, look at insurance companies, look at utility companies. Any company that's overcharging you or something, the stock is probably going up. Let's see other or is this oil company related to this? No, it's just a resource, okay? Like you gotta so the natural gas will go to the utility company and it will use that to generate electricity, right? As far as oil, no, I don't think any data center is using oil directly anyhow. Yeah. Maybe if they're using diesel generators to do backups. But no, it's not. It's probably natural gas. It's not going to be oil. Usually it's natural gas and coal. If you're third world, definitely coal. Coal is the way to go. I think Europe, yeah, they're not going to do coal anymore. Nuclear, yes, nuclear. We talked about nuclear stocks over the last couple weeks. So you can go back and look at them. Let me see which one I had earnings recently. LEU, yes, this one. Chart is very healthy. If you're gonna buy it though, I'd probably be cautious. Yeah, because we're at the resistance level right here. Yep. So LEU is one. So that's infrastructure. GEV. So this is GE that split off in their electric division that does infrastructure for power. So they also do nuclear. So you can see that doing quite well so far on this weekly chart. Uranium miners. So I'm looking at this ETF, URNM. And like I said, once it hit the top of this range, it's going to pull back. But I think this next pullback is probably the time to buy. And uranium ETFs are usually led by Cameco. So this Canadian ETF. And you can look at the history of Cameco. Cameco was the Canadian, I guess, semi-private company. I don't know. They call it Crown Company, right? It's kind of like the Hudson Bay Company, something like that, owned by your British royalty. Like they have a contract with them or something like that. So Cameco is one of those that came from that Canadian corporate structure. And you can look up nuclear or Uranium City. You can look up Uranium City, Canada. So it owns a mine over there. So Cameco CCJ is the ticker. Cameco. The other one, LEU, Centrus Energy Corporation. This is the one that Black recommended. And there was a couple other ones for nuclear. Light bridge, see, it kind of did this. It hit it hit exactly that resistance level right up here, pulled back. So yeah, watch these. LTBR, light bridge. NNE is another one. So this is more of an IPO risky play. So good luck with that. I can't recommend it. There's not much chart history. Yeah, see, that's why you gotta look at the chart. Man, it works out so well when you just look at resistance and support. You just go, So it dropped, drop below. No, yeah. You just can't buy a stock like this once it does its rally. You gotta wait for the bottoming process to happen. It reaches the top. Now, what's gonna happen is that if it's gonna continue going up, you're gonna have to look at the in between points here, right? So this one, I'm gonna change it to blue. Actually, I'll change it to something else. Let's just make it purple. So here, the low in 2018, see this green bar and this red bar down here? So this is probably significant. Yeah, you made a lot of support. So this is the monthly. Yeah, so these are really significant. So when you see like these actions around the month, that's really, and right here too, again, you see these two here, July 2020. Yeah. And then you see again 2022 and then 2023. So July, August 2022, July, August 2023. Let's say Lightbridge holds this. It tries to hold this $6.70 area. That might be a very good sign. Then this whole that means I can just consider this whole area a Wyckoff pattern, right? You see this? It goes that. It makes a point of supply here, like this spring area, and then it does this. It moves this. Like, oh man, let me pull up a diagram. This what Wyckoff diagram or something. That's why you gotta do your homework with Wyckoff, because you can just see it right there. That's perfect. This is a perfect classic picture. Let's see, Wyckoff blog. I gotta find some Wyckoff diagrams. I mean, I should keep them as like JPEGs. Man. I think the Hong Kong chart had some, right? Yeah, the Hong Kong chart had some. Or if you didn't hold, yeah, you had to make like a short, because if you see the volatility, like look at this, all right? So the ATR of this thing is really high. So yeah, it's just, man, it's too volatile, man. Like fuck, like I don't know what you would do. It would just be like, well, you have to accept that it can move up and down so much that you wouldn't have a, because yeah, let's say it hits here, because this is perfect too for the daily chart. You see the 18, like it would have to try to keep this area. It's almost down to that point. If it holds, that's very bullish. Yeah, you got the 18 moving average. You got that support line there. Man, I don't know. Maybe next week it'll pop. It's already volatile, man. Maybe I'll buy it. Maybe I'll buy it because I definitely don't. If it comes through it, then it's gonna be that means it will take a longer time to build up the next move up. That means this is gonna take a while. Yeah. But if it bounces quickly, then you'll be okay. You'll be okay. So here, like I did the one right for China, like this one. Yeah, so I did this selling climax, secondary test, spring, last point of supply, blah blah blah, and then I used this chart, right, you see. So I try to like emulate this, right? Like it matches pretty well. So let's copy that. Let's go to Lightbridge. Lightbridge is more of a insane looking one because it's not gonna exactly look like that, right? yeah, kind of, ish, sorta, yeah. So this whole area here, this phase D area, it's just way more volatile of a stock. Oh man. So I don't know. This yeah, we'll see, man. Because this is the first time it got out, so I'm assuming like here, got out. I have no idea how long this will take. If it'll be fast or not. It might take a while. It might take a while, dude. So you might be in it for the long haul. But yeah, definitely don't take the shot when it first gets up to that resistance. So always make sure you look to your left and see where things are. Yeah, before you do your thing. Because we already had that top here. But you might be all right if you buy more at 6 something. Right? Maybe that's it. That's the real entry. So you can make it up later. So again, check it out. Always look at the chart first. Okay, so I'm gonna have to figure out what I'll do with oil. We'll have to wait for the elections. Now, next one. This is a longer video. I haven't watched this, but it looks. It might have more information for the commodities and things like that. It might be a bit dry though. So let's see if you're awake. Maybe this will put you to sleep.
All right, everyone. Welcome to the 189th episode of Double Line Minutes. I'm Sam Lau here with Mark Kimbrell.
Hey.
Hey, Mark. It's just after 10 a.m. Pacific here on November 1st, 2024. A lot to talk about this week on the macro front. It's a big, heavy week next week as well. So before we get into it, do you have anything you want to unload off your chest about this week's past events that doesn't necessarily involve markets?
Hey, thank you very much. I'm just going to say go Dodgers. Sorry to Yankee fans out there, but better luck next year. And it was fun series, fun season. But now fall's with us, and I just taking it in still. But it was a fun time. But thanks, man. I just want to say go Dodgers.
Absolutely. I mean, it's interesting to see, and hopefully there's no asterisks around, behind this the 2024 year this time. But since we're in LA, you guys say go Doyers as well. We do have the parade as well. Just I don't know what time it started or starts or will be starting, but that's just going to wind right by our offices as well. So pretty exciting.
Yeah, I was tempted to drive in this morning. I think it kicks off around 12:30, but they're saying a lot of downtown is going to be on lockdown. So,
yeah. After some of the videos that you saw around, some of the darker side of the celebrations here in Los Angeles, that's probably, it's prudent, I suppose. Good risk management, I suppose. But with that, let's jump into the markets here. What I've got going on for the week to date right now is the S&P 500 is down about a point. It is, we are going further into earnings seasons. There was a couple disappointing, not necessarily prints, but forward-looking guidance, I suppose, in terms of what people should expect from the tech sector, particularly around the AI. I think people are starting to realize that AI comes with a cost, and that's cost is it's a heavy capex type of venture, across a number of different sectors and a number of different industries in order to get there. So with that on the week, alongside that, down a point so far in the S&P 500, technology is down about 2.5%. That's the big loser on the week. And that was some of the big dip happened yesterday, if memory serves, where, the tech sector was down about 3.5% just on that day. So it's kind of reflective of what we saw in some of the earnings disappointments this week. Alongside that, also in the down two handle for the week to date is real estate. That's down just a little bit less, down 2.4% right now. But on the flip side, we have one positive performer on the week to date basis. That's comm services. And I should say that's firmly positive at 2.3%. Right now, we've got financials up about 20 basis points on the week. So we'll see how the rest of the day goes. But those two are the only positive performers right now on the week to date basis for the sectors underlying the S&P 500. On a year to date basis, we still got about a 22% positive return on the S&P 500. So just a little bit more wood to chop for the remainder of 2024. But it does. I'm going to go out on a limb here and say that it looks like the S&P 500 could end the year with a positive sign in front. But we do have a lot of news coming out next week as well. So we'll see how things go. Certainly the market has been jittery around next week's election on Tuesday, and then whenever the results actually come out. And then, of course, on Thursday, we have that FOMC. So there's a lot of uncertainty in the market that, hopefully will be cleared up in the next week or so. But with that, moving over to bond land, we'll start out with the treasuries. And right now across the curve, I see rates higher, starting out with the 2-year note. We've got see rates higher, starting out with the 2-year note. We've got the 2-year treasury yield at 4.17 right now. That's 7 basis points higher than where it ended last Friday. Moving out the curve to the 10-year, that's at the yield of 4.34%. So that continues to push to new local highs, I guess, if you will, within this context of the last few months here. But that's up 10 basis points in yield on the week. And then for the bond's up 4 basis points in yield to point right now we're at a yield of 4.54. So what that all means for the broader bond complex as measured by the U.S. Bloomberg aggregate, that's down about 40 basis points thus far on the week to date basis. Still trying to hold on to this positive return. For the year, right now it's at 1.7% positive performance on the total return basis for 2024. Pretty much everything in the red right now. Leading the way down is IG corporate credits. That's down 60 basis points, followed by agency mortgage-backed securities down 50 basis points, and EM just about 45 basis points down. U.S. Treasuries down 40 basis points. And then when we take a look at the below investment grade cohort here, high U.S. corporate high yields as well as bank loans are pretty much just flat on the week at this point. Rounding it all out for a negative week-to-date print across these asset classes that we look at, commodity is no different. That's down 2% on the week. On the year, it's holding on to this positive return of about 4%. But really, when we take a look at it across, energy just got pummeled this week. Right now, when we take a look at WTI front month futures here as the proxy, that's down over 2.5%. That pushed the year-to-date number down a little bit lower as well, in line pretty much at down 2.5% as well, give or take. Earlier this morning, I saw that WTI was managing to hold on to the $70 handle, which I was a little bit surprised about just based on what we've seen over the course of the week. But right now it's hovering just 10 cents below that $70 barrel of front month crude oil futures. But the one kind of shining star thus far for not only the week, but as well as the year is gold. Your favorite asset right there, Kimbro. The shiny metal there is up 40 basis points on the week-to-date basis. Still shy of its all-time high of 2,800 a troy ounce and some change there. But right now it's at $2,751 a troy ounce, up on that front month contract. Price return up almost 33% on the year-to-date basis. So with that roundup of the markets this week, Mark, do you want to kick us off on this busy week that we had in macro land?
Yeah, let's get into this. Use a term we like to use. Let's strap in here because we do have quite a bit to go through. Use a term we like to use. Let's strap in here because we do have quite a bit to go through. Let's see. Let's start off on Tuesday. We had S&P Core Logic, the 20-city month-over-month measure for August. This is home price, generally, hopefully appreciation. That came in at positive 35 bips. That was 15 bips higher than estimates. And an acceleration from the prior of 0.25%. This helped bring the year-over-year measure to 5.20%, deceleration from a prior 5.93. This month we had to contend, at least the year-over-year number had to contend with a 1 handle or 1% handle roll-off, so not surprising to see the year-over-year measure decline. We're still getting strong HBA. These numbers are still firm. I will say that the number I said for month over month was seasonally adjusted. On a non-seasonally adjusted basis, it was down 32 bips. We're passing the home buying season, so is where it is. But thanks for the seasonal adjustments. Moving forward on Tuesday, we have the JOLTS job openings for September. This was a weak report. It came in at 7.443 million, about 550K under estimates, and about 400K under the prior. That prior was also revised down. Looking at this, we like to look at the job openings unemployed ratio. That came in at 1.09 versus a prior of 1.10. But to give that a little context, and I'm spewing some decimals here, but we were 1.08 back in July. What I'm trying to say with that is we spent about 3 months without a ton of movement in this ratio, and that's about the level that's, we'll say it's a little below where we were pre-COVID. So let's see if we can gain our footing here or if this metric resumes its fall. But all in all, the JOLTS job openings report was a weak report. Not going to dive much into the details there further than that. Also on Tuesday, we got the Conference Board Consumer Confidence Report for October. This came in very strong, at least that's what the headlines were saying. It came in at 108.7. That was 9.2 points above the prior and 9.5 points above the prior, 9.2 above the estimates. I want to give this also a little context. That prior was sitting near the local low of the year. So this bounce we had, it puts us right back in the context we were in August. I'm going to say these measures are kind of range bound and noisy. Great to see an improvement, but rather see an improving trend. So just going to say nice to see good numbers on the consumer confidence front or an improvement, but let's line up a couple more of those reports. On Wednesday, we had the ADP employment change for October. This turned the page from prior day. This was 233K. That was 122K over estimates and 74K above the prior. It's the highest print we've seen on ADP since July 2023. All that being said, today is Jobs Friday. I'm not going to front run what I'm going to talk about for Friday's economic data, but we take this report with a grain of salt. It's supposed to be an early look to the NFP. There's other data you can glean from it. I mean, most of the job growth was in the service sector, more so than the goods. It was more so with large companies rather than small. But you know what? We like the report, like to take a peek at it, see what they have, but we kind of focus on the one that comes out on Friday.
Yeah, I mean, the peak is the right word. It's like I rarely look at it beyond the headline, on that. In fact, Mayberry and I did a dive into the differences between the ADP and the NFP and why the numbers come out so different. But I always thought I guess humorous is a little bit strong, but it was one of those things where the ADP at one point, maybe they scrubbed it, but their stated goal was to front run. They didn't use the word front run, but they said to match and anticipate what the NFP would be just by, a day or two in front of the NFP report. So for me, I feel like I can have patience when it's due. And especially if I'm getting what is to be the actual data print that you're trying to match, I could wait 2 days for the NFP report without trading or even thinking about the ADP as reflecting within my investment strategy.
that seems like a safe choice. Anyway, that's well said. can't say better than that. So let's move forward off that data point and go to GDP. On Wednesday, we had the third quarter advance estimate, the annualized Q over Q number, came in at a strong 2.8%. That was 0.1% below estimates, 0.2% below the prior, but I'm still going to say strong, it's firm real growth when you're at 2.8% real. Let's break down the components of this. You got the top, the primary four components, or the four ones that add up to the 2.8. I'll cover this on a contribution basis, actually. We're going to do personal consumption. You got just shy of 2.5% coming out of personal consumption, the engine of our economy. Gross private investment kicked in 7 bips. Net exports took away 56 bips, and government spending contributed 85 basis points. So, I mean, look, the things that stand out clearly, personal consumption, that was the strongest contribution we've seen since Q1 2023. Look, the data we've gotten throughout the quarter, you think about it, even though labor market is slowing, we still have firm wage growth. We still have there still is job growth in general, and consumers are not afraid to tap their credit cards. We've seen that in the spending data. So consumption persists. On the other side of that, again, government spending, with an 85 bip contribution, that's the strongest contribution we've got there since Q3 of 2023. So, yeah, hey, that's the bulk of our GDP this quarter was the government spending and the private sector spending. So everyone's doing their job.
Yeah, it was one of those reports too that. sorry to cut you off there, Kimbrough.
No,
okay, so I was going to say that is one of those reports where we looked around and looked at the report, looked around at each other on the desk, and said, come out with what's the negative in here, right? It's hard to find the negative, at least from the reported numbers. Sure, you can say maybe consumer spending is being driven by credit and debt there, but on the government side, picking up the equation is especially in this type of deficit spending, that environment that we're in, is never a good thing. But overall, I mean, you look at these numbers on a real basis, it's quite strong, and it's one of those times where we're waiting for the bears to come out, right? Just like we couldn't find the negative spin, on ourselves. So we said, okay, let's wait for the usual bears to come out and put it out on the X, and we'll get that spin, and that never came out. And so we looked to our own internal bears, and our internal bears were noticeably quiet as well. So it is one of those things that you take a look at, and it's quite strong. Given that this is just the advanced report for the third quarter, and what is it? There's 3 or 4 revision periods that come out over this time.
Over the 3-month period, you get your standard 1 revision each month. So your advanced, your second, and your third, and then there are the periodic adjustments that are still done. But it's the 3 is the main ones we look at.
Yeah, that makes sense. And then the final comes out when the fourth quarter, or when the next quarter's preliminary comes out. So I mean, take it how you will, but there's many a slip betwixt the cup and the lip, right? So that with those 3 revisions that come out, we'll see how that goes as more data comes in.
You know what I did? I was trying to scratch the surface. I still was digging a little bit on the negatives, and I came up with a couple for you.
Let's hear them. We got to hear them.
So you know what? We can always look. Net exports, we'll set that aside. We run expanding trade deficits on occasion. Those numbers can be noisy, so that is what it is. But we would like to see a little firmer investment. The gross private investment contribution of 7 bips, like that's the pipeline of future growth, what you're investing in, and that's we'd love that to be a little stronger. We've had back-to-back negative quarters of residential construction. That's not a positive thing. So I shouldn't say residential investment.
Investment, yep.
But so I mean, look, that's what I could scrape off the surface there. That's or I should say digging a little deep. Those are the 2 little. So I'm gonna leave it there. Let's just say that's a strong quarter. Yeah. Moving forward to Thursday, we had the employment cost index for the third quarter. This came in at 0.8%. That was 0.1% below estimates and 0.1% below the prior quarter. This data going back to Q4 1996, we've averaged a quarterly print of 74 bips. So I'm going to say this 0.8%, we get them on a rounded basis like that. I'm saying we're in the context of normal. And, you don't want to take one data point and just say that's, I don't want to say one data point's a trend, but this is one data point along a trend of slowing data. And that's the disinflation we've been seeing. So I'm going to say this was another encouraging print, something that's showing, we're making progress on the pace of disinflation. And wage growth is still firm. If you look at the year-over-year numbers, you're 3.9% on a year-over-year basis on this figure. So again, it's decent print here. Also on Thursday, you got personal income and personal spending for September. We'll start with income. That came in at 0.3% month over month. That's right in line with estimates and a slight acceleration from the prior month. The 20-year average for this for personal income is 0.4%. We came in a little below it, but year over year, we're right at 5.5%. On a 6-month annual basis, we can see a little deceleration. That's growing at 3.9%. You're getting basically 3/4 of that from wage growth, another quarter of that is coming from transfer payments, and then the rest kind of washes out. But personal income persists. I mean, it's again, you see that in the spending numbers, which came in at 0.5% for the month of September. That was 0.1% above estimates and 0.2% above the prior month. But split between goods and services, you get about 1/3 spending in goods, 2/3 in services. Both grew at a rate that was above 50 bips. Got 54 bips for goods, 53 for services. So that's how you get your 0.5% on personal spending growth. In general, you get a little more volatility in good spending. It's nice to see a good month there, but services has been persistent. And to give some more year-over-year context for this, 20-year average year-over-year spending is 4.59%, and we're at 5.06% now. So I'm going to say spending remains firm, at least for now, or in the rearview mirror. Also on Thursday, we got PCE data, usually extremely accurate relative to estimates. The headline month-over-month number for September came in at 0.2%, again in line with estimates, and a slight acceleration from the prior month. That brought the year-over-year number down from 2.3 to 2.1%. But more importantly, we get core PCE. That came in month-over-month at 0.3%, in line with estimates, and a slight acceleration from the prior month. We ended up not getting a change. Both year-over-year measures declined, but we didn't catch the round for the core number. That was unchanged at 2.7 versus estimates at 2.6. I'll give you some precision here. We had 2.72% on the prior, 2.65 on the current, so both around 2.7. Closing out the year, the roll-off figures are not exactly pretty. We have 0.13%, 0.09%, 0.18%. So possibly not a whole lot of progress to be seen on the year-over-year front for core PCE, but it's been a good year so far on the disinflation front. Starting to wrap this up, we got initial jobless claims also on Thursday for the week ending October 26th. That came in at 216K. That's 14K below estimates and 12K below the prior. And we got continuing claims for the week ending October 19th, coming in at 1.862 million. That's 18K below estimates and 26K below the prior. In general, look, I've been talking about this for the last few weeks. Hoping to see some of the storm effects start to wash out, no pun intended. And we're seeing it here. So we'll give it a couple more weeks, see how it goes, but it's nice these are coming off their peaks. That brings us to Friday, aka Pizza Friday, Jobs Friday. It's a fun Friday. We got NFP. That was not a fun print, though. That came in at 12K, 88K below estimates, and 211K below the prior. Nothing close to our ADP report. It's the lowest print we've seen since December 2020. But again, the October, we're still dealing with a little bit of storm effects. I'm just going to say that this is a noisy month. Let's hope that this clears up in the months to come. Going to
Sorry, before you go into the U3, I mean, the payrolls estimate, I always kind of scoff at estimates just because, I've mentioned this in the past. I think a lot of it is just economists putting their fingers in the air, and just trying to gauge where the wind's going to blow next, right? But I felt like this 100K estimate was kind of garbage, in the context of, I saw a lot of economists coming out and saying that their expectations was that there would, you have to fade this particular payrolls report by 150K because of what you just mentioned, because of the effect that the survey came in right around the period that overlapped with many of these storms that we just had, that we just underwent. That and the fact that, they knew that the Boeing strike, there's about over 30,000 workers that weren't going to be receiving payroll that week. The fact that they came out with a 100K estimate on top of that, it just seems absurdly high to me, especially in the context of recent, prints on the NFP as well. When I was looking at that, and if I were to take that 150 into consideration, I was actually thinking yesterday that maybe we might even see a negative non-farm payrolls report number come in. But certainly not something like 100K on top of what people were talking about there. So I don't know.
Oh no, so I was saying on that note, let's give it a little time because I mean we just got 2-month net revisions of negative 112K. Well, that's been the trend in general over the last year and a half. Well, last month we had positive net revisions. That was kind of an outlier. Would be surprised if this thing potentially ended up going negative. It wouldn't be out of character for the state as of late. So I totally hear you on that.
So it's one of those things that hopefully market participants are kind of fading this current payrolls report, which it does seem like they are a little bit. But again, it's hard to tell with all the uncertainty that could be cleared again up with this next revision on the payrolls, but also what's going on in the next week. So just kind of, I mean, my take is just kind of fade this report.
I think that seems like a very sober take. So let's, wrap up our Jobs Friday. We had the U3 rate coming in at 4.1%. Unchanged from the prior, in line with estimates. That doesn't sound like that jives with what we just was seeing for the NFP report, but that's explained by the labor force participation rate. That declined to 62.6%. It was a 10 bip decline from the prior and below estimates. I mean, looking at the underlying data, you had the population increased by 209,000, at least the way we create these estimates or these numbers. But the labor force declined by 220K. So, I mean, that's, you didn't have, people weren't just flying into the employed pocket. We had 368,000 job losses on the employed side, while the unemployed only increased by 150K. So you have people leave the labor force, the unemployment rate gets a little help to be able to stay flat. Again, we're 4.1%, still not too high, but we'll see how that continues to progress. And fading this report in general, let's see what we get in November. And then lastly, Friday, we have ISM manufacturing for October. Came in at 46.5, 1.1 points below estimates, 0.7% below the prior. Weakness persists in ISM, manufacturing. We've had 7 consecutive prints below 50. Looking under the hood for all this, all of the demand components are in contraction. All of the consumption components are in contraction, thinking production, consumption of resources, both human and capital. And prices actually bounce back into expanding mode. So this is just, I guess the prices maybe is a positive from I guess prices maybe can be the only thing spun as positive here, but we don't want to see rising prices. So manufacturing continues to be just in the doldrums. It's chugging along and it's contracting. So we'll see when that ends. There's plenty of anecdotes in the report getting hopeful comments 2025, but it doesn't, nothing speaking too well for the rest of the year on the manufacturing front. And that, thanks for hanging in there, but that wraps up the week.
Yeah, definitely a busy week. So thanks for leading us through that. For any of the listeners out there who have, any questions on some of the stuff that Kimber was talking about there and want us to take a deeper dive as a potential topic of the week, don't forget you can go ahead and sling them into us via our X or emails, which we'll talk about, which I'll give out at the end of this podcast because I can't. Well, actually, I'll fast forward to it now. It's our minutes at D-Line Minutes, or you can send us the email at minutes@doubleline.com. But with that, moving forward, Fed speak, quiet week, blackout week. So nothing the Fed doesn't say, is blackout period before next week's FOMC meeting. In terms of what the market is predicting or is putting in terms of the probabilities for Fed fund via the Fed funds futures for the FOMC meeting coming on next Thursday, 11/7. Right now, it's pricing in a 25 basis point cut, pretty much fully. For the remainder of the year, it's also pricing in one other cut. Right now, it's 81% probability, or 82%, let's say, probability of a second or another 25 basis point cut at the December 18th meeting. So that's kind of that is right in line with what the Fed had indicated as what the number of cuts that we would see in 2024 at 1 percentage point of total cuts for the year. In terms of the things to keep an eye on next week, we've got ISM services on Tuesday, but right now the estimate's coming in at 53.5, so still firmly in expansionary territory despite being a little bit lower than the previous period of 54.9. I'm sure all that's going to be overshadowed by what we're going to find, what we're going to start on Tuesday with the elections. And then on Thursday, we should have some information on what the FOMC is actually going to do with their monetary policy, both from the rates and perhaps from the balance sheet side as well. But right now, it's expected to go from an upper bound of 5% where we are today to 4.75% on the upper bound. That should be an interesting presser. I mean, the market participants are going to be looking to see what the Fed, see if there's any clues out there on their forward-looking guidance, especially at the back of the election. I'm sure there's going to be a lot of questions that they're going to try to sneak in for Mr. Powell around, his thoughts about the potential new administration there. And I hope his answer is going to be, no comment. It's nothing to do with us, but we'll see how he handles it, and we'll see what color tie he has. But that pretty much wraps it up for this week, Mr. Kimbrough. We do have a lot of things out there.
All right. So, not much to say, honestly. Everything is as it was last month. So the market, I think, is going to have to figure this out next week after the elections. Because, yes, the jobs report was noisy. Because of the storms, the strikes, nobody knows what's going to happen then. Because, like they said, it could be revised lower, but maybe that's a good thing. That could mean that there'll be more cuts involved. Who knows? But it could also be a bad thing, because then they might take it in a bad way. Sometimes bad news is good for the stock market, and sometimes bad news is really bad. It's just too bad. That's what we don't know, how the expectations will be. Now, let's see here. I'm going to show this video. This is going to be an extra video to show you guys.
Sell in here, then sell in even in these two bars right here with the attempts to go up and an ability to do so. More selling comes on this bar, and then we are seeing selling in this attempt to go up, in this upthrust right here, and in this bar right here that does not commit. We tried to rally into the middle of the day, and yet we're still closing lower and closing below a couple of closes that we've done just recently. So I think that our next target is going to be somewhere here, this line where we stopped before, around the Fed day where the demand came before. We're probably going to be easily retesting a tail of this bar right here, and maybe going into the election, coming into this area.
All right. So let's see, guys. You see that? You see that line there? Yes. And this was just before the drop from Meta and Microsoft. I keep forgetting Microsoft, but yeah, that's what it was. So let me show you the chart again, because it's important as we get into it next week, because we need to get ready to buy, like I said, if it's going to reverse from that level. Oh man, it doesn't even show that right now. Let me see. Okay. Let's see this. I'm gonna pull up the S&P chart. So let's look at a clean chart like this one. Okay, we're here right now. So that's the line they drew. Pretty close to it. So I think it's about a couple percent down more, huh? Okay. And it's good that it hits the rising 18 moving average here, right in the blue line. And we're still on that upper channel. So it's really important, I think, for this to hold and then continue up. Because I don't want to see this thing fall right through. If this thing falls right through again, you have to remember these 3 weekly candles. And, of course, it got this nice green one from that bottom. But if it drops here, I think what happens is goes sideways, tries to go up into January, and then fall right back down. I wouldn't like that. That's what I'm expecting might happen if it does that. So this line in the sand at 5,600 ish. Yeah, you wanna try to hold this area at the very least. So if it does drop down again, yeah, you just want to keep holding this. Ideally, it'll just bounce right after Powell talks and we're done with the elections and goes right into Thanksgiving. That'll be the best case scenario. Yeah, so watch for those. Watch for those. We're going to have to see. Okay. Now I'm going to show you this video here with an update from Joe Rabel. So you can go to the link in the description. You can see that link here.
This channel is for educational purposes only. Please do your own due diligence before making any investment decisions.
This is Joe Rabel. Welcome back. We're going to do a stock market update, and we've got some shifts taking place on the shorter term time frames. We've got to take a hard look at that and see how meaningful they are. And then we're going to look at some spots of where support could come in and maybe just frame out what we should expect. All right. And if you want to learn more about some of these techniques, especially with the MACD and ADX in multiple timeframes, I would suggest starting with the book. You can go to rabelstockresearch.com/book for more information. Also, if you enjoy this content, please hit that like button and also subscribe. Okay, let's run through the market conditions. We currently are showing no change this week in the sentiment. Still have it at neutral. It's borderline. It could be a little bit more this way. I wouldn't quite put it in the negative camp. Again, we're looking for something closer to 40% before we would look at that. Now, I'm sort of expecting it to drop from here now based on what the market is doing. But just have to keep an eye on that. Again, they update that on Wednesdays. And so overbought, oversold. We've got this RSI 5 that has dropped down. Actually is at 47. It must have just ticked lower in the aftermarket or something. So we're looking at, reaching the neutral camp. All right. We're not overbought, not oversold. Not what I would call an ideal setup on the buy side right now. And the main reason is this, this volatility is still too high. So one of the things I've been talking about is the question is that when we pull back to the 18, would it be big bars, right? If we got orderly small bars, then this could keep dropping and this could roll over. And then all of a sudden we could have ourselves a nice little pullback setup. All right. I'm going to go into that a little bit more in just a second, but let me just point out a couple of things. Number one, last week, the momentum switched to neutral on both the weekly and the daily. It wasn't a small thing. It was kind of a big deal to me to flip those over simply because, market had been motoring along here. So I'll go into those in a minute as well. Now, the daily chart has flipped to neutral as well in terms of the trend. All right. The momentum had already started to kind of give it up a little bit, but now we're getting a potential trend shift starting to develop. I'll go into that in a second as well. All right, let's look at this, what's taken place here today. So one of the things I talked about with my subscribers this week was, we had low volatility on this time frame and high volatility on this time frame. All right, we had a nice pullback here and I'm going to show you in a second how the MACD helped us determine that we were going to get a little test. All right. And then if you noticed here, we did the same thing. We got another test. This time, instead of triggering back to the upside, we're actually triggered to the downside. When I get to the hourly, you can see how we kind of define this. Now, one thing I do want to point out, we are coming up against some price support from the breakout area, and look at this RSI 5 on the daily chart is down in the teens. All right. Now you can go back and look at this. This is pretty low. I mean, this doesn't get this low that often. Now it doesn't mean it's going to turn on a dime. It just means you got to be a little bit careful about getting too bearish at this point in time. Doesn't mean it can't go lower. Just means, a lot of times I see guys and they're like, oh, I want to get short or something like that. And then this bounces up while this is rolling over. And then you're really kind of in a really uncomfortable position because you're kind of right, but your timing is wrong. So that's why we want to use the hourly. I'm going to show you kind of what I would be doing now based on that. But I think the big thing is the volatility is still high on the weekly. All right. The daily is shifting upward, but not to the point where it's turning negative. It's still positive right now on the volatility for the daily chart. All right. Now, one of the things I just want to do is just, I want to point something out. All right. So I've got a monthly here, weekly here, daily here, and an hourly here. All right. Now, when I pull up a chart, and I want everyone to understand this, I know I'm analyzing the S&P every Friday, but the reality is I'm trying to show you how to analyze any instrument, and how I would go about doing it. And so, one of the things, if you watch the Tuesday video, right, we were stretched here and we were kind of getting stretched here, very similar to what I was talking about in that AFL pattern. Okay. So that's the first. So one of the things that I notice when I go through and look at charts and I pull up a stock and I have these 4 time frames up, I just want to take a general glimpse and just what hits me right away. Right. And one of the things that's been hitting me is how long this has been kind of stretched away. And it just is, it's a little uncomfortable, even though the momentum is fine. All right. So once I get 2 time frames where we get stretched away, then we want to be looking a little bit more closely at these time frames for signs of reversal. All right. So just something I like to just want you to understand that one of the ways that I'm looking at things. All right. So we've been talking about the trend being positive on the weekly. All right. And the MACD really did confirm this last peak. It made a higher high here, this peak to this peak. That was a higher high, and this was a higher high. So I know you could go back and compare it to that if you want. I don't usually do that. I look at the most recent one. Again, I try and stay in that 8 to 12 bar window when I'm doing that. So I don't really consider this a divergence, but I am a little bothered by the fact that this is flipping back down. Now, again, it's on the weekly. So if we got to come back on Friday, if Friday's trading is good, then this might not close below the signal line. But something you want to be watching here, if that turns down from this juncture, I think that really increases the likelihood that we've got a correction on our hands, and it's going to head its way back and test this area of the 18-week, which is something I think makes sense to me. Now, one of the things that's bothering me about this, and what I've pointed out again to subscribers, is I like the fact that the green was above here, but the fact that it didn't really break out and go, and we had 4 or 5 weeks straight of up moves, it couldn't cause this to really get going. It's concerning to see this ADX so low. I mean, we're at 16 after a pretty decent move to the upside. So it's not really confirming to the upside, and now we're getting a big red bar here. I think if I'm looking at this on a weekly chart, I'm probably looking for a re-entry of this breakout area. If we have enough weakness and we come back down through that, then we come.
So you see that? So that analysis matches with the Wyckoff guys, right? So I think so. I think we're going to drop there at least next week.
Kind of confirm the reversal. Now, when we go to the daily chart, you can see we're kind of already increasing the odds that we're heading down to the 18-week, because look at what happened. We actually had a reverse divergence signal here. This was a reverse divergence. So this was making a higher low. This was making a lower low. All right. But at the same time, we had this move up, this pullback, and then look at what this played out. We formed this counter parallel lines. These are all signals from my course. I think that it's definitely worthwhile if you want to learn some of these techniques in detail. The course is going to give you a lot of examples and how to kind of go through that and understand them better. Now we're kind of thinking that the bias is to the upside, so we don't have any preconceived notions. And that's why when I look at this there's a positive signal here, reverse divergence, and then we have this counter parallel line signal that is basically a bearish pinch, All right. This is walking along the 18, but it's not bouncing off the 18. I don't like that when it's almost like water building on a dam when it sits and keeps staying connected to the 18 on this time frame. And while this is staying below, it's almost acting like an anvil and creating some weight to it. All right. Now you'd add in this for this to get this range. That's a big giant red bar to the downside. I mean, that's a big elephant bar, a big giant red bar to the downside. Don't really want to see that, but it does increase odds that we're going to come test. I think the 18 week, I think that's a pretty high probability, especially with the election coming. I kind of was surprised that we weren't starting to get a pullback leading up to the election, but maybe now we pull back into the election and then we'll see what happens. Now, I want to look at this hourly chart because the way I had framed it out this week for my subscribers was we had a trend line break here, we pulled back, and then we were consolidating. So we had this horizontal line up here to shift the trend and confirm the trend going back to the upside. But at the same time, we also had essentially a trend line break to this side. All right. I mean, meaning we made a move. So you really would be connecting. This is the anchor for the pivot for the trend line. We did break that trend line here, and then we have a horizontal line here. So I basically have a 1, 2, 3 setup in both directions. All right. Meaning I don't have to be a hero. I don't have to make a decision. Now, what I will say is this looked like a rally and a downtrend to me with overrun. Right now, it ended up coming down, bouncing up, coming down, bouncing up, and then coming down through. And then obviously pretty tough trigger unless you took the 40 break. I mean, really, what I was suggesting was either looking at, this trend line here that developed near the end or taking out this horizontal trend line here. And obviously it happened via a gap. Now, I mean, what you can do is look at the RSI 5 on the hourly and see if you get some kind of a retracement back towards these moving averages and see if it fails. And if that happens with this kind of strength, then there's enough room to the 18 week. So this is how I would frame this out now. I know we've got a pretty high probability that we want to work this down to the 0 line on the MACD here. And I think there's a pretty high probability we want to come back to this next trend support, 560, something like that. So the question becomes, can you create yourself a setup on a rally here, get an RSI sell signal here, all right, closer enough to the moving averages. And the reason why I want to use the RSI here, I get some questions on this. I mean, you see the strength that we're pretty far from the moving average. And so what I don't want you to do is look at this as just any kind of a minor rally and short it because we're a little too far from here. We're already kind of getting into this next support zone. So the way I do it is I look for an RSI signal. I need the RSI 5 to get back over 50 and do that for a closing hour. And then if we're close enough to these moving averages, then you have a pretty good setup for a potential move down to next support on this time frame. See, we've broken the trend, we've broken support on this time frame, and the next target area is going to be in here. All right. Now it could break the 18 a little bit, but you kind of want to use that as your barometer in how you're framing out your next trade. So if you're going to trade this to the downside for either shorting it, just free shorting it, or doing a hedge, I think you want to set up. Now, you could have done the gap down this morning. Obviously, as I mentioned, you could have done that. Kind of a rough entry. Obviously, it would have worked in your favor. And if you did that, good for you. But I think you could wait and see if you get a rally if you didn't do that. And see what kind of rally it is. I mean, if you get a monster green bar here, then you don't really want to be doing that. But if you get a weak rally back towards the moving averages, get that relief rally on an RSI 5 basis, and the RSI 20 stays below 50 with this kind of strength, I think I'd be willing to play that to the downside. All right, so that's the update for the week. Let me know if you have any questions. What I will say is this looked like a have any preconceived notion. All signals from my we actually had a reverse divergence signal here. This was a reverse divergence. So advantage in individual stock requests that came through. So let's go ahead and get into this lesson now. Okay, so I've got a daily chart of HOLX up. I want to start out and discuss standard divergence first. So we make a move to the downside here. We rally up, and what I want to do is compare the valleys or bottoms in price and the peaks in price with the MACD. So MACD is making a new low.
So I haven't gone over the MACD too much, but for now, just treat it like an oscillator, okay? It just goes up and down in a range. All right. So usually oscillating indicators are like the RSI, relative strength index, that he was talking about earlier. That's really common. Like most TA, that's the first indicator they start learning. Okay, MACD would be the second one. So, and I mentioned that the MACD is using the two EMAs, so two exponential moving averages, to create this signal. So when you look at this, it's usually this black signal here is the main signal, and then you have a moving average of that, which is the red signal. It's called the signal line. Okay, but for now, all you got to do is look at the black one, and you look at the price, right? It makes highs and lows locally, and then you match it with the highs and lows of the MACD, like he's trying to say here.
It's dropping down and making a new low for the move, and then we rally up and MACD rallies up, and then we go down and make a new low in price, and MACD makes a new low, right? So we want to compare each peak and each valley with the indicator, starting with price and then using the MACD to confirm that, all right? And then we rally up this time, and MACD rallies up as well, but then we make a new low here, and this makes a higher bottom, right? So we've got divergence in place. This is convergence, where they're in agreement, and this is divergence when one is doing one thing and one is doing the other. Now, the standard divergence is very popular. It's talked about a lot. And, when we're trying to look for signs that the momentum is changing, and in this case, it really called a reversal. But you're not necessarily expecting this standard divergence signal to reverse the trend. You're going counter to the trend, right? We've got a bigger trend that's down, and we're getting a counter trend rally. So I typically am only looking for either a move to the moving average or to the prior peak. That's usually what I'm expecting out of a standard divergence. I'm not necessarily looking for a major reversal out of a MACD divergence play. However, if we start to move up here and we go and we make a pullback and you make a new high in MACD, and then we pull back here, and then we make a new high to the upside, we get a little bit of a standard divergence again, right? We're making a higher high in price and a lower high in MACD. But watch what happens after that. So we've got this kind of benchmark low here, right? And if you notice, we make a bottom that's above this, but it's also above this previous peak as well, even though this is making a lower low. So we're dropping while this is not dropping, okay? And so that's kind of our first sign of a reverse divergence that's kicking in. Now, what I like to do is I will typically look at what the pattern looks like at that point. So if I'm showing a reverse divergence right here, I don't really see a pattern developing yet, because it looks like it's in the midst of a consolidation pattern, as opposed to, like, these two lines are still really far apart. It just doesn't look like it's quite ready to get going yet.
the other thing that I notice is that we've still got some distance between where the MACD line is and where the zero line is. Now, there are times where it'll just take off from here, but usually when that happens, we have a better setup in place on the price chart with the moving averages. It'll have a more compressed pattern, and it look like it ready to reverse. The other thing that I'll notice is if we wait for another swing, now this does make a minor lower low here while this is making a lower low, but I'm looking at it in the context of the bigger pattern, and the bigger pattern is basically sideways to up, while the MACD pattern is really downward, and it's working off the overbought condition without really price giving back very much. So I still consider this a reverse divergence, even though we made a slightly lower low. So I wanted to use this as an example because it's a little bit different. The other thing that I would point out is that you know that you've got something that's a little bit more interesting from a reverse divergence standpoint when it happens right at the moving average. This is a rising 40, and we're coming back to that line. A lot of times you'll get a reverse divergence, a quick one, and it doesn't really show up here, but like where it's right at the 18, and then you know that you're probably ready for the next leg to the upside. But we finally got back to the 40 here. Now we're getting closer to the zero line, and look at what else. The ADX line, which back here on the first one wasn't really low yet, right? And then we dropped down below both DI lines, and we had a low ADX condition. We got very close to the zero line, and we had a pullback to the 40, which is steeply rising still, right? So we have reverse divergence, low ADX pattern, and a zero line reversal. And these moving averages are starting to come together.
Look at the last point. The moving averages are going together. Now, you don't need to know about the ADX at the bottom here, or even the MACD at the middle panel there, right? If you just looked at the two moving averages, that pink line and blue line on the chart, the 18 and 40, the ones that I kept highlighting on the XBI chart I was doing earlier, it's kissing, right? Those two lines are kissing. That's enough for you to know something's about to happen. Now, that reverse divergence and all this other stuff, you know, this is very interesting because it adds more evidence to the weight. Now, if you didn't know that and just looked at the kissing lines and whatever, and you were looking at the candles and saying like, oh, it's building energy, because you're looking at the way it's moving, it's in a range, right? It's mostly going sideways. So you saw in the Bitcoin chart too, it had that. The Bitcoin chart was moving sideways into October 2023, and you had two moving averages about to kiss, just like this. And it's about to pop up, and you didn't need those extra indicators down there. But if you did know those extra indicators, you know, they confirm what you're seeing just by looking at the price action alongside with the moving average. So that's all I'm saying. All I'm saying is like you can practice with this as simple a way as possible. I think that's highly recommended for beginners, just to try to do as much as you can with the simplest techniques, and then later on start adding to it more complexity, because then your eyes are getting familiar. Okay, so just do it slowly, right? That's what I'm gonna do. And from here we can go on to a next video, but I'm gonna show you a chart, quick chart. All right, so I'll just play a little bit more.
So that's kind of how I would use all of these different patterns together. One of the things that I teach in the course, my trend and momentum course about this pattern, I give people homework to go looking for this because it's a little bit harder to find. It needs more, you've got to go through and search for it so that your eyes are trained to find it. So I wanted to spend a few minutes touching on this again. It's a great pattern because it's in the direction of the trend. Where this is counter trend, we've actually turned the trend to the upside, and now we're getting a chance to play a divergence signal, right? Where this is dropping downward and this is moving upward in the direction of the trend. So I find that to be actually a more powerful signal than the counter trend standard MACD. Okay, so let's go ahead.
Yeah, I mean, if there's no correlation, then yeah, something's wrong. Something is probably wrong. and that's why you wouldn't take it. I mean, this is why the more solid indicators you use in a system, in a group of systems, the better it is. Because when I first started talking in the month, I was talking about secondary indicators, like I was using ratios to determine if the stock market would drop or not. That was one of the things I was doing, and not all the signals would hit, because some signals would say, oh, maybe this means the stock market will drop, and sometimes it will miss certain things, right? It will miss certain times. Another time it would hit and it will be good. Like, you need to have a system. You got to have a process. You just have to have signals that you commonly use and will constantly use to verify and double check each other. And the more they are aligned, then the more likely you'll take that trade. The less they hit, then the less likely. That will be where your probabilities will come in. So yes, that's right. It's going. That means there's a trend, right? That means it's following a trend. That's all it is. That's all it is. It's just a trend following. It's not there to predict anything by itself. Honestly, you're doing it alongside looking at the candles is what you're doing here. Now, if you're not like really good at looking at the candles and trying to make a pattern from the range with just the moving averages, right? Then yeah, of course, I think adding the MACD will be beneficial. Definitely. That's definitely one thing to add. But I think you can see a lot from it just by let's say you don't do the MACD or even the ADX or any of that stuff he's saying, and you just look at moving averages. That's it. And then you just add Wyckoff to it. That's probably sufficient to do everything he does right here. Like, you'll just keep looking at these patterns and going like, oh, okay, this looks like accumulation. This might be distribution or something. And then when you look at the moving averages and how they move closer together or apart from each other and how they move together, then yeah, you could just combine all three of those. That should be fine. Yeah, but I really like the way he looks at the MACD, like the way he says like it gets closer to zero. There's gonna be a change in the way it's trending, like it just like, okay, so it's working off its energy, it's going closer to zero. Then if I'm looking at that range and I see those moving averages close together and pinching, then yeah, it will start popping off alongside with the reverse divergence. So yeah, that's why when you look at more and more of these videos, everything starts clicking, because everything he says, it comes from whatever course he's teaching and all that. And all it is just like, all you're doing is practicing your pattern recognition. You're just looking for the same patterns. What the Bollinger, I don't know. I mean, I was talking about TTM squeeze the last time, and the TTM squeeze uses the Keltner and Bollinger bands. Okay, so yeah, Bollingers kind of give, you know what? I feel like Bollingers are sort of like where you draw the channels, but man, yeah, I think it's too much. Bollingers uses the standard deviation, right? And then Keltner's uses the average true range, if I remember correctly. Yeah, and then people would just use them just as a measure of volatility in some sense. Keltner more than Bollinger. Bollinger is, yeah, it still is a measure of volatility. Yeah, Bollinger's will also measure. So if you get over like the channel or below, and then you think it's oversold or overbought, but yeah, I tried using them sometimes, but yeah, I'm not really a big fan of Bollinger's or Keltner channels. Yeah, there's a standard deviation. So that's why I said for the Bollinger. So you can look up Keltner channels too, but they'll use a ATR, average true range, not the standard deviation. As far as I don't know where they compute the standard deviation for Bollinger. So let's see, Bollinger. Let's see, Dan. Standard deviation formula. What is it? What's the standard deviation? How do they figure that out? Standard deviation measures how prices is moving from the average classifies. Yeah, okay, but what's the actual formula? So we gotta go to stock charts to find the formula, huh? So 20-day standard deviation of price times, okay, by a factor. Usually it's set to 2, or someone could set it something else. Yeah, they usually set it to 20 periods. Yeah, that's about it. Yeah. They'll just take 20 days and make the standard deviation from that. I don't know. Honestly. Yeah, I don't know. I think the dumb way is just like if it gets on top, they'll just sell. But yeah, because once you're in a trend, why would you do? I mean, yeah, why would you do that? I mean, that's not a guaranteed signal either way. Yeah. So let me just put up this about the standard deviation. Let's see. Gotta find that tab. Divergence. Divergence. Divergence medium. Okay, here. I think this was a good website here that I found. Put the link up. So I'll just show it on screen. All right. Here you go. So this chart will show you everything. So usually there's a standard divergence, which you can see here. So price makes a lower low, and your indicator, they call an oscillator, is going up. So this is the MACD or RSI or any other indicator that's an oscillator type. Okay. So if price goes down, oscillator goes up, then it goes up. Price goes up, oscillator goes down, then usually it will go down. Okay. Now the key here is these hidden divergences. Price goes up, the bottom of the prices. So the bottom, the lower peaks here, the valleys, my bad, valleys. So it makes a higher low, like you said, right? Make a higher low. And then your oscillator makes a lower low. That means price goes up. If the price is here, you see the tops are going down, but the oscillator is going up. Price goes down. So these are what they call the reverse divergences or hidden divergences. So you can go to that link and look at it. But these are the ones you want to spot, because from what Joe is saying, these are more powerful signals. They're a lot more powerful. So let's look at another video that he did where he goes into it in depth. Okay.
This channel is for educational purposes only. Please do your own due diligence before making any investment decisions. Hi, this is Joe. Welcome back to the channel. And today I want to talk about reverse divergence or hidden divergence. I had a specific request to go into this in a little bit more detail. I talk about it in my book, and I have done a few videos on it, but this is the type of signal that I think you need to see more examples of, because actually it's incredibly powerful, especially when it happens at the right time. And so let's go ahead and get into the example, because in fact, I have two different examples. And one of the things that I think is important is recognizing where, and this goes for not just this reverse divergence signal, but any of the signals that I use, is figuring out or recognizing where it is in relation to the trend. So if you get a signal in any of these signals and it happens early in the trend, where the trend is really just getting started, that can be the kickoff move for the whole trend, and actually just give you an early signal that you can play for a much bigger target. But if it happens later in the trend, after it's already made a breakout move and a pullback move, and this is the second move in the uptrend or second signal in the uptrend, then you probably want to play it for shorter targets. So that's how I would consider, that's how I think, look at it. And again, and that would go for any of the other signals that I use. Now, MACD has some really nice trading signals like the pinch plays, but again, you want to look at it in relation to where you are in the trend. So that's the first thing. So when I look at, so let's just first talk about standard divergence. So if price makes a move to the downside, rallies up, and makes a lower low, yet the MACD comes down, makes a low, rallies up, and makes a higher bottom. Now we have divergence, because this is making a higher bottom and this is making a lower bottom. Now we always look for confirmation in price before doing anything when we have this type of divergence. And in fact, any type of divergence or any signal, I'm almost always going to wait for the price to confirm. However, when you're looking at reverse divergence, we've got the opposite going on. Price comes down, makes a low, and then comes down and actually makes a higher bottom, while the MACD line comes down, rallies up, and makes a lower low. So this is coming down and making a lower low, while price is making a higher low. So that's why it's called reverse divergence. Now, one of the things I really like to look for is, as you know, I'm a big zero line, MACD zero line guy. And so I am watching for a specific signal to take place near anytime. So if we get across to the downside in the MACD lines, I'm looking for the pinch right there, or to the upside. I love the pinch play right near the zero line. If we're looking at reverse divergence, let's just use this example. First, we'll talk about the Starbucks example. So stock makes a move to the upside, pulls back, and we get a new high in MACD, and we pull back, and there's no sign of divergence whatsoever. It's convergence. It means that the indicator is doing exactly what price is doing. But then we make a higher high here, and this actually is standard divergence developing to the downside. Now, one of the things that I would tell you is standard divergence against the trend is not a meaningful thing. It's most of the time it's just telling you're going to get a pullback to the moving average. It's not necessarily calling for a big reversal in the trend. Now, if we get something a little bit more meaningful in ADX to confirm that divergence, then we can look for something more significant, and that's when ADX can't get above 25. I've talked about that in other videos. But look at what happens. So we've got a bottom here, and we move up, and then we get another bottom forming, well, at least a pullback here. And this made a low in MACD back here, if you look at it compared to that. And then we rally up, come down, and then this makes a lower bottom. So we're lower here, we're going lower here, and we've got a significantly higher bottom here. Now, the fact that this is taking place, like I said, after you broke out, after you've had a pullback, it's already made somewhat of an extended move, and you do have a sign of standard divergence potentially developing. What I would tell you is I'd be willing to take this trade, but I would play it for a trading move of 3 to 5, 6 bars, something like that. And I'd be watching it as it's moving, looking for signs of on the actually go down a time frame to the daily chart and look for signs of either divergence or some kind of a big upside move bar or something, take advantage of getting extended away from the daily 18. Any of those would be potential exit points. But this is a pretty good signal when you get the lower low here and a higher bottom here. Now, if you notice what happened, now we have this bottom, and after this rally, now we have this bottom, we made a lower low in price, and we made a lower low in MACD. So that's convergence. They're in agreement. So price is doing something, and so is the MACD. It's doing the exact same thing. Now, we did have a layer of standard divergence at the peak because this made a higher high and this made another lower high. And this time the ADX did not confirm by getting above 25. So then you could look for something a little bit more meaningful than just pulling back to support. Okay, so that's one example. I want to give you this other example because this, I think, can really help us and when we're looking for a bigger move out of this trade. So let's look at the bottom that was made. So first we can look at this low versus this bottom. So we made a higher bottom here and we did make a lower low here. It did follow divergence and you had kind of made a decent move to the upside. So again, it's more of a trading move, 3 to 5 bar move to the upside. And it really, all it did was test the high. Still not a bad trading play, especially if it's happening on a weekly chart and you go down to a daily and you want to swing trade, knowing that there's some potential getting back to this old high. But what I think is more powerful is when we compare this bottom to this bottom. Now we've made a higher bottom in price, but look at this lower low happens near the zero line. Notice how the ADX is very low. So when we see that, and I'd almost prefer to see these moving averages come together, something like that, and have one of our signals from the moving average standpoint. That didn't actually happen, but sometimes it'll happen quicker like this. And that's okay. So I would be going down to the daily chart during this phase, looking for a signal to play it to the upside. Normally, I don't play this off the same time frame, meaning this is just a backdrop. This is the setup. And then I want to go down to the daily chart to look for a signal that's going to get me in for a move to the upside. So this
is the setup, right? So you're using the weekly chart to get the setup, and then you go down to the lower time frame, and what they would say is they call that a trigger. So you're looking for the setup for the trade, and then you try to fine tune it so you can find exactly the point where you decide I'm going to trigger the trade, okay? And that's what he's alluding to when he says he goes down to the daily time frame after looking at the weekly. So if you're a lower time frame trader, like you're the day trader, then you would look at the daily and then you would go to the hourly or something like that to find the trigger. Or maybe more likely the few minutes, right? You're looking at the hourly, or you got to figure out how you want to do this. All right. Yes, you got to figure it out. You got to find your time frames and stick with it. I mean, the best ones is like you're using multiple time frames as possible, up to 4, and then trying that way. So you look at the monthly trend and then you're following that trend, and you go down to the daily all the way to the hourly, and then you would use everything together to try to find the most optimal trigger and setups that you can. Now, that's going to be more complex, I think. Even I don't do that right now. I just like looking at 2 time frames and just keeping it simple. But someone like Joe here would probably be like, yeah, I look at all 4 at once just to find the best probable trade to make. So the more confluence, I use that word again, confluence, the better. The more indicators that align, that means there's a higher probability the trade will be successful. And this is more of a thing that you should consider when you're in a volatile trading environment. Because right now everything's easy. You know, COVID was really easy. But then when you get to the 2022 era where like interest rates was rising and that whole year was like up and down, Ukraine, this, that, Russia, this, that, you know, I think you would have to be more sophisticated on which trade you pick, right? At that point, you would not take trades just on basic signals because yeah, they're not likely to succeed at that point. But when you're not in a nice trending market, it's easy because there's less chances of volatility. When you have higher this is why, yeah, you've got to take into account more things when you get more advanced, you know. I think most people, when they see a volatile market like in 2022, they get out, they stay out. You'd rather be in a bubble market, right? When most of the time stocks are moving up. All right, so keep that in mind.
How I'd go about doing it, but notice what happened here. Zero line reversal with the lower low, which is a reverse divergence at the zero line. Look for this pattern when you can get that opportunity. I think it's pretty powerful when you can get that to happen, especially if there's low ADX in place. Now, if you notice, I would still consider looking at this as a profit-taking opportunity here or, you know, during this bar somewhere, because look at this move. You made a nice move to the upside and you get this extended, huge individual bar that takes place. And so, you know, when I see that, I'm inclined to want to take profits when I see that. But you could have scaled and trailed in this situation because it was starting at the zero line and played for a little bit bigger move. If you were down on the daily chart, you'd have seen some signs of divergence that would have helped you exit this trade. So anyway, that's the example I wanted to give, a couple examples I wanted to give, just to give you a little bit more insight into the reverse divergence. I mentioned it on my last video with respect to a trading play on the market, but I just wanted to give a little bit more detail and a couple of different examples. So post any questions or comments and we'll see you next time.
All right. So we're almost at 4 hours. This is probably the longest edition of this show. And in the coming weeks, you know, into November, I'm going to try to like not do these type of long shows because I think you guys have a lot of the basic ideas. I'm going to go over back to most of my videos, see what needs to be explained, repeated again, but in shorter form or in more of a lesson, and I'll tighten it up, maybe more presentation style. But I probably will stop doing a lot of these long form videos because I think a lot of these old October videos will cover the basics that most people need, and then I'll just hammer in more of the concepts that I feel are very important over and over in shorter form videos throughout the day, but I mean throughout the week. But I'm going to use the scanning stuff. I'm going to try set some up so that through Thanksgiving we should start seeing more regular short form videos where I go over stocks that are recommended. I'll quickly just go over the charts, what I see from the chart. I make a list, and then, you know, you could go like, okay, this is for swing trade, this is for day trade, this is for whatever. Ideally, maybe, I mean, first it'll just be more investment ETFs where I rotate them. I'm gonna show, and I'm gonna have to start with a paper trading account on TradingView, follow my trade, see how it works, go over them, review them towards the end, say like which trades work, which didn't work, what did I do wrong, what did I do right, and improve it, and then get other people into it too, where everyone can just be like, I can just question people. I can just pick some tickers and say like, well, what do you think is going to happen with this chart? And then, you know, give a poll out or something like that, and people can vote on what it does, and it kind of like homework, right? Most of this stuff is just repeated work. It's honestly not anything more complicated than that. Because here, I'll show you the last video of the day. You can see what, if you're a fundamental guy, this is what happens. All right. If you're a fundamental analysis. Actually, I had one more video to show, but I guess we're not going to get into that. I guess I'll have to save for next time. But yeah, we can go see Martin Shkreli again. I mean, Grace and Ben went over Martin Shkreli's interview with, I guess, Milo Yiannopoulos. So, might as well talk about him. Because, yeah, he is an interesting person. So let's see. Let's see.
We have a request from Godel, so I have to prioritize that. Make sure you sign up for Godel. The guy wants Avago, which I've never looked at. This used to be called Broadcom. Okay, so this is maybe how you would look at a stock from scratch. So this might be helpful to some of you newcomers. I like to look at what's called the capital structure first, or the kind of 6 most important things I look at in any stock. The first is the stock price, which is pretty simple. This is the last sale of the stock in any given market. In this case, it's $156. It's unimportant to get it exactly right. It doesn't really matter that much what the pennies are. Now I'm looking for shares outstanding, and you can see that the last 10Q, there are 463 million shares outstanding. And then if you multiply those two numbers, you get a market cap, and that's 72 billion here. I thought Broadcom was a bigger company. Maybe they did a split or something. We'll have to see, and we'll just that'll be discovered as we go through this. They do a 10 for 1 or something like that. This is March 1st, so we'll just check the news out and see if they did a stock split. Okay, here's the balance sheet. I just like to take the cash, which is 11 billion in this case. And then I'd like to take the debt, which is 73 billion in this case. And the enterprise value is basically the value of the company net its cash position. So in this case, the value of the company is higher than its market cap because the company is a net debt position. But again, I want to check right now about that stock split, because that's unnerving me a little bit. So I'm just Googling investor relations, news releases, and you can find this in Godel as well. 10 for 1 forward split on 7/15, so that was 2 weeks ago. So if you split your shares 10 for 1, you have 10 times as many shares. So this is a market cap of 722 billion, one of the biggest companies in the world. Just to think about how big $700 billion is. It's about as big as Berkshire Hathaway, Warren Buffett's company. It's bigger than every football team, baseball team, and NFL team combined by far, still times 10. It's bigger than almost every country's GDP. Not every country, but quite a number of countries. If you asked me back in my day, if there'd be $1 trillion company, I'd say maybe. And then if you told me there'd be a whole bunch of them, and even if I'm not streaming, I'm happy to do some requests for you if you subscribe to Godel, which is part of my new software company. Yeah, we can go through this a little bit more slowly. That'd be my pleasure. And I have a number of videos. They're not necessarily on my channel, but you should be able to find some of the old videos I did on financial analysis. So I'm going to start with the income statement. In some ways, for most tech companies, it's a bit more important than the balance sheet. The balance sheet's important too, don't get me wrong, but they're both important. So I'm going to put the dates down here as well as the calendar, because this is a company that has a different calendar quarter from their fiscal quarter. So if you ever get confused in calendar and fiscal, and even the big brained of us do, just look at the dates, and those are the 90 days ending those dates. So you don't have to break your brain too much. And if you line them up together, as I'm about to, it gets a lot easier. So for example, they called this quarter the second quarter for the fiscal year 2024. So I do fiscal Q2 24. And by the way, if you follow these videos, it turns out that most of Wall Street has adopted the Shkreli method, which is kind of crazy. I'm very flattered by that. Revenue is the products that you sell. In some countries, that's called turnover. It's either revenue, sales, or turnover. Sometimes also called top line. So that's just product that goes out your door. The only interesting thing about revenue is when do you recognize your revenue? Revenue recognition is a tricky question. Usually, you recognize revenue when title passes. You do not recognize revenue. The normie will often think that you recognize revenue when you get paid. No, never, ever, ever, ever. That's a rookie mistake. You recognize revenue when title has passed to the customer and the customer owes you money. Whether they paid or not is not that important. So you can see Broadcom grew pretty dramatically. I think that was due to an acquisition. I think they bought VMware, if I'm not mistaken. They got a little bit more into software. And just off the bat, I can do this really interesting calculation, which is new divided by old minus 1. And that's 43% growth. Year. All right, so 43% revenue growth must have came from an acquisition. I will call up your mom and flirt with her and copulate. Don't test me. You think Shkreli doesn't know how to be entertaining? I taught all these guys how to troll, bro. I taught them how to troll. Cost of revenue is often called cost of goods sold. It's the same thing. And gross profit is revenue less COGS. So you have revenue, and you take away or subtract cost of goods sold. Somebody's asking about efficient market hypothesis. I think markets are mostly efficient. But if they were really efficient, there wouldn't be any good investors. And there seem to be some good investors out there. And also, studying financial statements gives you a great insight into business in general. So you don't even have to be trading or investing. You can just be studying an industry. And you have to know this stuff if you want to know the industry. Hopefully that helps. All right. Gross margin is 75%. So that
All right. You guys understand, right? So you gotta be a wizard in Excel. You gotta spend your time looking at financial statements. You could just do all that if you want. I personally don't. Okay. Yeah, I'm not gonna do that. So let me show you this. We got 2 more minutes before the 4 hours here. So I had someone ask me, about something to recommend to buy. This was back in 2021, I believe. And they said buy Avago. So that was the stock Martin Shkreli was looking at. So this is back in 2021. So I believe it was around here. Now they had a split. So let's see what the split was. Split was 10-1. So okay, that makes it easy. This was about $420. I said buy at 420 because his brother, he wanted some recommendation for his brother. His brother only likes to buy shares excess of around 10,000 shares. So his brother only likes conservative looking stocks. So okay, I picked this large cap. It's a leader in semiconductors, I thought. And I just look at his chart, I think the CEO is good. That's all I looked at, the CEO. So let's look at this chart. So we know that this point here, COVID, bounced back up, got to a new high into February, tested this double bottom here, because that area is probably this whole zone in December with the green candle here. So I say, okay, green candle here, touch that. I say it's a good place to buy, right? Somewhere around May. Probably that's when I recommended it. Said get it. And you see the moving averages moving up, right? Okay, it does this little pinch like we discussed earlier. The moving averages are kissing. It pops up, right? Into December 2021. Actually, yeah, it went right all the way to New Year's. That's pretty nice. Now, let's assume, I don't know what happened after that. I don't know if he sold it or not. Let's say he kept it. Let's just say he kept it. Okay, so it goes from 40 to 60. That's about 50%, right? Yeah, that's 50%. Let's say around 50% gain. Let's say he's greedy. He didn't sell any of it. Just kept it all. I mean, you get if you're doing 10,000 shares minimum of a $400 company, because that's before the split, so that's about 420, right? That's a lot of fucking shares. I mean, I don't know if he actually did buy it. I don't know if he was that rich or not, but you say, hey, you know what? That's $4 million bucks. If you got that money, go for it. Go for it. If you're that rich, go for it. So let's say he's greedy. He didn't sell a damn thing. He kept it all the way down during the era of higher interest rates going into October 2022. It hits that level again. Okay, hopefully he didn't sell it. Hopefully he wasn't panicking and going like, oh shit, it's right back to where it was when I bought it and it's about to dip below and I'm freaking out and I sold it. Let's say he's not doing that. Let's say he's smart. He holds it. Guess what? Comes back here, moving averages goes back. It does this little range here. Pop, 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 pop. Goes all the way back up here. A lot higher than that first initial 50% gain. So that's about, let's see, what's that? 300%, not bad. 300%, that's 4 times, right? So what I'm trying to say is that, yeah, you can look at financial statements, all that. I'm not going to do that. I'm not going to do that. First, I look at the CEO. One, if I really care about long-term investment, look at the CEO. Then, what the trend. And then after that, look at the sector. Because that's the important point that Martin Shkreli was making there. Study the sector. But I'm not going to study the sector using financial statements and look at every company in that place. What I do is, like, I have my scanner, right? So that was the first thing I was teaching you guys with scanning. I scan through the industry, looking through the industries of the sectors, right? Seeing what's strong. If you see semiconductors moving up in this point here, up, and you were looking at the best of the best companies, this was one of them. Okay, it was definitely this one. I could look at another company in the sector like MU. Not as good, right? So I'm trying to look for the best of the best. So Avago was one of those. So I didn't need to use any of that financial statements or going through spreadsheets to analyze it that way, because I assume that the market is smart. Well, at least, like, you know, some participants, they'll be dummies, right? Most of the retail will be doing this like short-term stuff here, but in general, you could tell from the chart where the smart money is, and that's why I keep harping on the whole looking at the Wyckoff stuff, because you are trying to figure out what the smart money is doing. That's it. Heat map section. I don't know. I also look at like the percent gainers and stuff. I know they have that heat map and they have a whole bunch of other stuff, but no, I usually don't use that. Let's see how good it is. I'll try it out. Let me see. Yeah. Oh yeah, you just. Oh yeah. Okay. I mean, there's other websites that do heat maps like that. So that's what you mean, like FinViz. You use FinViz. FinViz also has like a simple screener. Like they also have a heat map there too. I mean, I don't know. Yeah, FinViz is pretty cool as a free website. Yeah, go to Finviz. Finviz does that stuff. You can go to Finviz. Here, I'll show you Finviz. Finviz was the place people went to before, for free screeners and things. So they have a free screener. They got the heat maps. And hey, I'll show you guys the Shkreli Godel terminal. It's pretty neat, honestly. So, and I showed it a couple times already. So here's the Finviz. See that? Looks pretty cool. And then you have the screener here. So the free screener, you can do whatever you want here. So yeah, this is what people used back in the day. You can screen everything, see what the presets are. Not bad. Yeah, you have the fundamental analysis, you have the technical screening. Yeah, you can use this thing too. No problem. So go back to home, and then you got the heat map right here. See? Pretty neat, pretty neat. It's pretty damn neat, right? Yeah, so check it out, and Godel, you can go to Godel terminal here. So this is Martin Shkreli's little baby. GodelTerminal.com, app.GodelTerminal, GODEL terminal. So yeah, you can look. Like here, I'm looking at Apple's financial statements. See, I do Apple. I just type in the ticker like here, and then I put CF, and then I can get the whole thing. So let's look at Avago. So Avago CF. So I can look. There you go. So I can look at Avago's. See, I can look at that form, SEC form 4. See, SEC forms, 8K, 10Q. Here we go, 10Q quarter report. I can just look it up. Let's see, can I click on this thing? No. See, open original. Okay, oh, cool, neat. See, I can open the original here. SEC website, not bad, not bad. Pretty neat. He has Palantir on his homepage. Who doesn't have Palantir, man? It's gonna be it's probably the top stock out there aside from Nvidia. Anyhow, but hey, we got earnings. I forgot earnings Monday for Palantir, so watch out. Might not be a good time to be holding that thing, But I'm definitely gonna be. Well, HB is holding it, so whatever. He's gonna take his chances. I don't know. But I'm a long-term holder of that thing, so but even I'm like kind of skeptical about keeping all the shares in there. But yeah, neat. So you can just go here and copy all these numbers and put them in your Excel spreadsheet. Do all that stuff. Enjoy, analyze everything, free cash flow, trying to determine everything, and all those videos I've shown here. I think at least most of them, maybe a couple of them, I didn't put links in. It's in the description. So if you want to watch the rest of that Martin Shkreli video, go to the description. You'll see it. But yeah, it's pretty neat stuff. Yeah, you even got this chat room here. Look at this chat room. Palantir is crowded. Same for app. I don't think it's a good time to enter. No shit. Saw the Milo interview. That guy has serious ADD. Oh man. Let's see. What other chats we got? We got biotech. Got people chatting about biotech. Not bad. Pretty cool. Well, cool website, I gotta say. It has that old school look. Pretty clean. If you like that nerdy terminal type of Bloomberg terminal or any type of terminal like interface. Not bad. Oh boy, I think my memory is about to die. Playing this thing here. Got StreamYards and Godel going. Probably gonna kill my laptop. All right, dudes. It's late. I gotta leave. Good Saturday night stream. I think that'll tide you over until the excitement happens for elections. You know, I'm gonna have to figure out what leftover concepts I need to teach that are important. I'm sure there are some, but you guys can go back to all my previous streams. It's on the playlist at the Urban Landlord. All right, guys, Urban Landlord, this channel, because this is just the beginning. We only did 1 month of this, charting the course series. There's gonna be a lot more. Probably have a mailbag section, get an email in. I don't know, Tropes, did you email Portia your question about something about AI? Yeah, email to her. But if it doesn't get to me, then yeah, ask again in chat. We'll have to get an email set up to ask questions, and then I can go through it, because I think John wants with me and CKJ3 to answer different questions, you know. So we'll see. A lot of ideas, a lot of concepts that will have to be answered for sure. Okay. Let's see what else. I was gonna think about talking about SPACs too, because looking at old stocks that used to be SPACs as well. Yeah, because I was asked a question about SoFi from False. I want to ask about SoFi. Let me see. Let me go quickly over it. So this will be for my memory here, just to remind me to talk about it again later. So SoFi, SOFI, he was in this stock. So it's been doing pretty good runs since August at the market low. We hit earnings, not bad. It held it. It dropped at the beginning. So after earnings, it dropped and it went back up. So it's holding that area. So yeah, that's definitely an important resistance. Yeah, it's all the way back here too, huh? Right from. So a lot of these SPACs, they're kind of like IPOs back in the 2021 era. COVID, it was in the COVID times. These were very popular. You can see this is like a structure here. So I told him, like, if it pulled back, he would try to buy it. Like, let's say this point here. Ideally, it would try to stay above 8.5. So let's say it pulls back, you would buy more if the market, I think, is doing good. Now, the reason I mentioned this is because there's a lot of other companies that were SPACs that have completed their transition into companies, like Oscar. This one, Oscar Health. You see this? It made this pattern here, and it's doing a little kiss, right, with the moving averages. Oscar, OSCR, and Clove, same thing. So this is another health insurance company that was a SPAC. but this one's kind of far away from its moving average and entering the region where it had trouble breaking out back in 2022. So yeah, it could be something interesting to watch. Another one, WSG, I mentioned. No, not WSG, WGS. Right, GETCRACK right here. Yep. Made a complete V shape, like crazy, $1 to 77. This was a SPAC as well. All right. And another one that was discussed, VRT, I believe this is also a SPAC. This one came out a little bit earlier before COVID though. But yes, also interesting. This one did data center water cooling. That's what it did. So yeah, a lot of companies that were SPACs looking very interesting. And yeah, we have to continue. I think a Virgin, what the heck, Virgin Space. Yeah, this one was terrible, isn't it? Ooh, yeah. This one is utter trash. But in any case, like, I should make a list of all the companies that used to be SPACs. I think it's like a really good tell of how the market will do in the coming 6 months. If you start seeing all these type of stocks move up, regardless of how they look now, like this one is terrible. Another one was Lucid, right? The electric car company. Oh yeah, another terrible one. So this one, Space. Like, let's look at all of them as a group. Let's consider them all as a group and see if they actually have a trend going up, back up. If it's going down, it's going back up, or if it's going up and it continues going up, then we can use this as a way to gauge how market sentiment is for risky, unprofitable stocks. And that aligns with ARK, Cathie Wood's ETF. If I see this breakout, ARKK, I see XBI breakout, and I see IWM breakout, and I see all those SPACs that you saw start breaking out, I'm going to say we are entering the next phase of the bubble, where this will be try to do a repeat of the 2021 move. All right, the 2021 move. That's it. Okay, guys. All right. I'll see ya in the coming days. Let's see what happens when we go into elections. It's going to be quite lit. I think we'll have a lot of interesting streams for people. You guys hear that? Donald Trump is like good for Argentina. Man, something's playing in my ear. Man, it must be that Godell. Heck do I know. All right, guys. I'll see you before I go any crazier staying up. Yeah, you can. Yeah, you can. But I tend not to do that. I mean, you could just do this, right? New price scale. See? You do that. It'll just get messy. Yeah. I did that with the what was that? What was that chart I did? Was it this one? I don't know. I did something where I just did all of them like that. Did I do it with this one? Man, it was way back when where I went over all the little gainer charts. I gotta name these things better. Yeah, I did one where I went all over the place with multiple charts at once. Yeah, I forgot where it was. I don't think it was any of these. Yeah, okay. But yeah, you could just do that. I just heard something from the Godel website. Yeah. It must be that. It must be that Godel thing. It probably says all mine says unnamed. Yeah, I'm lazy too, man. I'm not like Portia, you know. Portia would be so awesome at this. Like if you have a company, you know, you really need something where, like, let's say I try to make a hedge fund or something. Yeah, you need the right people. You just really need it to organize. You have people that does all the work for you. So you can add everything here, you can add everything there. And I think, yeah, one way when I did it with the charts was that like, let's say I did hymns, right? I did hymns. Like this one with the drugs. It's just moving up on the health, the diet pills. I mean, the diet pills, that's what it was. So I can compare it with XBI because it's really good comparison, because this is what I did in the previous stream. You see how well it lines up. So this stock follows, because it's probably a SPAC too. The way it acts, like 2020, it's around $10. This is how you can tell a company was a SPAC. When a SPAC is made, when it does its quote unquote IPO, it's always at $10. It starts at $10. That's, for some reason, that's one of the ways you could tell, is because that's how they are all set up. They always start with a nominal price of $10 when they get listed. And you see, if once it gets listed and it starts moving, because it's completing its stage where it's getting absorbed by the actual holding company, kind of like Donald Trump stock too, DJT, same thing. Yeah, so it starts at $10. You see here? Yeah, that's how you know it was a SPAC. So anyway, you go to HIMS, it starts following the rest of the biotech sector. So that's why the XBI, proxy of the biotech sector, it goes to the bottom, you know, it follows it, but you see it starts breaking out. It no longer follows it. That's why you need to look at the ratios. Like if you just did HIMS over XBI, you could see something starts changing when it breaks out on a relative basis, like around here, like February 2023 on this candle here. So if you look at the ratio, and that's when you really know something was changing. It really was no longer following the underlying XBI group. So that's where the leaders, that's how you find your leaders. In any case, yeah, I'm gonna be watching this stock too. This is perfect. The way it's setting up, it looks perfect to me. It's gonna have earnings on Monday, I believe. Yes, Monday 1st. I'm gonna be watching this guy. Maybe it's not, it's not smart, but you might have bought it on Friday when it was down here at 18.5. I don't know. Like if you look at the daily chart, yeah, it makes sense. This would be like a support, but because if you look at the weekly, right, it's starting to kiss. I don't know. This might be the kiss, and it's just gonna fly up after earnings, regardless of what the election like stuff is. But it's too risky for me. This would have been a better entry here at the 13 on here. Yeah, this would have been the perfect entry. Then you could just hold it through elections if you wanted to and see what happens. But buying up here is just a little too risky, especially when the 18 is kind of flattening out like this, the way it is, you see? Yeah, so this kiss could happen right around December-ish, right? This thing could just keep going sideways. You buy here, you might risk like even it dropping to temporarily below into 16. But yeah, watch this stock. Watch this stock. Okay, guys? All right. I'll see ya. 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 And keep watching. Keep watching tickers. I hopefully the scanners and things, it'll make it easier for me to find new perspectives in a faster manner. And then, yeah, we can really get going. Really get going on this stock picking endeavor. Alrighty. Good night, all. Good night.